This hearing of the Senate Economics References Committee into Australia's financial regulatory framework and home ownership. I begin by acknowledging the traditional owners. Today's hearing will be conducted via video conference and in person. Today we have Senators Walsh, Barbara Pocock and myself so far. And these are public proceedings being video streamed live via the Parliament's website, and a Hansard transcript will be made. I remind all witnesses that in giving evidence to the committee, they are protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to our committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses also have a right to request to be heard in camera. The Senate has resolved that an officer of a department of the Commonwealth or of a state shall not be asked to give opinions on matters of policy and shall be given reasonable opportunity to refer questions asked of the officer to superior officers or to a minister. This resolution does not preclude questions asking for explanations of policies or factual questions about how and when policies were adopted. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist upon an answer, having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. Commonwealth officers appearing today are also reminded of the Senate order specifying the process by which a claim of public interest immunity should be raised. A copy of the order is available from the Secretariat. I remind all people today who are appearing via video conference who are not speaking to please mute your microphones. And I now welcome representatives from the Australian Banking Association. I understand the information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, please state your names and capacity in which you appear.
Chris Taylor, Chief of Policy of the Australian Banking Association.
And Craig Evans, Policy Director at the Australian Banking Association.
Thank you. Do you have an opening statement?
Yes, Chair, I do.
Please go ahead.
Good morning, Chair and members of the committee. Australian banks are committed to responsible lending rules, APPA requirements and the Banking Code of Practice to protect consumers purchasing a home. Owning a home is central to the Australian way of life, and banks are committed to supporting first home buyers. In the last 5 years, banks have provided $298 billion of loans to over 683,000 customers to buy their first home. This is a 41% increase in customers over the previous 5-year period. But with rising house prices and a lack of affordable new homes, the dream of home ownership is becoming harder to achieve. Our submission to this inquiry covers 3 areas that I will briefly speak to. First, building more homes and building them quickly is essential. New housing supply is at a decade low, with only 172,000 homes completed last year, while house prices have surged over 40% since COVID-19. To create more opportunities for young Australians, we need to build more homes. The best way to increase affordable housing is by implementing policies that will increase supply. Second, without needing to make any changes to law, there are some minor updates that could be considered to regulatory guidance that would help more first home buyers safely access credit. Today, APPA requires a 3% serviceability buffer above the loan rate to ensure borrowers can manage higher repayments if rates rise or their circumstances change. APPA's buffer could be more flexible for first home buyers, adjusted for a borrower's circumstances and for market conditions. This could give more buyers a leg up when it comes to purchasing their first home. Third, banks support responsible lending rules to protect borrowers and ensure that they can repay their loans. However, current obligations for assessing a first home buyer's serviceability don't account for their stronger income growth potential compared to other borrowers. First home buyers are assessed on their ability to repay a 30-year loan based essentially on their first year of income. Existing regulatory guidance could allow more flexibility for lenders to consider a borrower's future income growth where it's prudent to do so. There is no silver bullet to address the housing affordability crisis, but increasing housing supply and sensibly balancing policy and regulatory measures to improve credit access could help making home ownership a reality for more Australians. I'm happy to take questions.
Thanks very much, Mr. Taylor. I might kick off by asking you what your view is on the idea of having a lower serviceability buffer for first home buyers. What kind of impact do you think that might have for those prospective first home owners?
Certainly. So in assessing first home buyers' suitability for a loan, there are essentially two regimes that apply. APPA's approach in considering serviceability as well as responsible lending obligations. And first and foremost with the responsible lending obligation, it's essentially about ensuring that a borrower has the capacity to repay a loan. The serviceability buffer, which is applied by APPA, is set at 3% above the rate that a home loan borrower will be offered. And that's essentially intended to ensure that borrower has a buffer against potential rises in interest rates or changes in their circumstances. Now, APPA's key mandate is to ensure the protection of depositors within banks and the stability of the financial system. But recognising that since COVID-19, house prices have increased by 40%, there is some merit in as part of APPA's normal review of regulatory guidance, considering whether an additional degree of flexibility based on an individual borrower's particular circumstances could be applied on a case-by-case basis.
So what impact do you think the 3% serviceability buffer, which is currently applying, even though interest rates no longer, or the cash rate is no longer 1%, it's now over 4%. What impact do you think that's having on prospective first home buyers? Is it meaning that there are people who are missing out on loans that they might be able to service?
So, Senator, as I mentioned in my opening statement, the increase of loans to first home buyers in the past 5 years is 41% higher than it was in the previous 5 years. The long run average is just under or around 30%. And in July 2024, it was 35%. So there are actually more loans being provided to first home buyers now than the long run average. However, recognising the very large escalation in house prices and the increase in interest rates does mean that a borrower's borrowing capacity has reduced, primarily as a result of the increase in house prices and the increase in interest rates. One of the submissions put in by one of our banks does do some calculations on the impact to borrowing capacity, but balanced against the long run average. There are more loans, but it is an issue that does need to be further considered.
Senator, just to add to that.
Okay, your view record is, sorry, did you want to add to that?
I was just going to say it's not necessarily a case of borrowers being denied loans. It might just be a reduction in the ability of the amount that they could borrow, and that might have some implications rather than being denied access to finance.
Okay, but so your view is that just so I get it right for the record, so the serviceability buffer does warrant review. That's your view, is it?
So both APPA and ASIC do review their regulatory guidance from time to time. As I said, APPA's primary responsibility is ensuring the stability of the financial system, and they do review and reflect changes to their settings to reflect current market conditions. We think against an increase in house prices over the past 5 years, this is an item that does warrant further consideration, and we would support a sensible discussion with APPA on the review of this buffer to make sure it's appropriate to ensure that there is a balance and flexibility for first home buyers when considering their applications.
Yeah, okay. So effectively, your view is that there could be a more dynamic approach here which responds to market conditions?
So as we said in our opening statement, the issue that is primarily being faced at the moment is a lack of supply. And we do think that ensuring that more first home buyers will be able to afford a home will come in focusing on policies that address supply, in addressing some of the obstacles that exist for the development of new homes. Housing Australia estimates that until 2028, there'll actually be a structural shortfall of 100,000 homes, and this is a market imbalance that is best addressed by supply. However, you cannot buy a first home without a mortgage, and it is sensible to continue to review settings to make sure that they are appropriate and operating as intended.
Okay, that's useful. Thank you, Mr. Taylor. So then, what about the proposal on capital risk weights? If there were changes to regulatory capital requirements, what impact do you think that might have on mortgages?
So, Senator, we haven't suggested any changes to capital weights in our submission. As I mentioned, APRA's primary responsibility is to ensure the protection of depositors and the stability of the financial system. And Australia does have one of the most resilient banking systems in the world. APRA and the policy settings that APRA has set and the policy settings that ASIC have set have stood borrowers in good stead and the banking system in a good position throughout recent financial crises. And we think that they do a good job. So we don't have any suggested changes to the capital buffers. No doubt, as part of regular reviews and monitoring the market, APRA do look at capital buffers and ensure that buffers that are being capital allocation that's being allocated to loans is appropriate for the risk, and we think that is an appropriate way to consider it.
Okay, so your view is that the serviceability buffer does need to be looked at, but I want to ask you briefly about two other quick things. So in relation to the Credit Act, do you think that there are some improvements that could be made to allow banks to take into account future earnings capacity?
Thank you for the question, Senator. So responsible lending obligations at their heart ensure that borrowers understand the loans that they are going to enter into and that they have the capacity to repay the loans. They won't be in hardship from servicing and making repayments on their loan. And as an industry, we fully support the responsible lending obligations. There is some recognition, though, that first home buyers in some ways are a riskier type of loan. They tend to have a lower deposit, which means their loan to value ratio is higher than more mature loans. But they are also at the beginning, usually, of their careers and have a higher income trajectory throughout their career. There was some recent research done by the RBA that showed first home buyers in the whole don't tend to present a greater risk of default than a broader set of borrowers. But there needs to be balance in considering that approach with their ability to withstand financial shocks in the context of the stability of the financial system and ensuring that they can continue to make repayments on their loan and that loan is appropriate for them.
Okay, so I want to go now to the Deputy Chair, but just to summarise your evidence, so you don't think that there are avenues to improve the credit laws?
We think that there are, and like any of these measures, they should be reviewed on an ongoing basis. We think that's appropriate and sensible for regulators to consider. We do think that there is a challenge that first home buyers face in finding affordable homes. We do think the large measures should be focused on supply, but reviewing settings around regulations on an ongoing basis is a sensible thing for regulators to do, and they often do that.
Okay, so the biggest bang for our buck in a regulatory sense in this space, in your view, is for us to look at the serviceability buffer then?
In the context of supply being the primary response and ensuring that credit settings remain appropriate for first home buyers and into the future.
Okay, I think just for the record, take that as a yes. That is the most fruitful demand side measure we could do in conjunction with a supply side agenda.
Correct.
Okay, thanks, Mr. Taylor. I'll go to the Deputy Chair.
Thanks very much, Chair. So I'll just start on the supply issue and then come back and explore your comments on the serviceability buffer a little bit more as well. So you've said in your submission and you've said today that, you know, far and away supply is the biggest issue here in terms of improving affordability of homes, you know, for everyone and for first home buyers who we're all concerned about. Obviously, the government has this $32 billion pipeline of private social affordable homes. There's a lot of work going into trying to reform planning and zoning, and we're seeing that play out where I am at the moment with some, you know, interesting Victorian government initiatives to try to deal with supply. Why is it that you say supply is the biggest issue at the moment for improving affordability?
Thank you for the question, Senator. So as I mentioned earlier, Housing Australia suggests that there's a structural shortfall of 100,000 homes at the moment, which means effectively demand is outstripping supply. We're seeing that play through not only for home ownership, for owner-occupiers, but also in the availability of rental properties. The national vacancy rate for rentals is 1.2%. It's widely acknowledged a balanced market rate would be around 3%. And we have seen escalations in both house prices and rents. We do think that supply is the most appropriate way to address this imbalance, and that's where the most fruitful measures will come from ensuring affordable homes are being developed in the places where people want to live, and that they can ultimately afford to purchase them.
Thank you. So supply is the sort of the most effective measure we can put in place to generate affordability. I'll just come to the serviceability comments that you've been making, and just to explore really, you know, what your thinking is there at this point around that. I guess a lot of people would say that the serviceability buffer being set at 3% for a while protected people who had entered into mortgages a while ago and did the job exactly, you know, during the last couple of years to protect people as interest rates did, you know, go up at those sorts of levels. So first of all, do you broadly agree that the buffer has been important over the last couple of years? And then I guess subsequent to your answer on that, are you more just saying that there might have been a time over the last couple of years where APPA could have looked at reducing the serviceability buffer as house prices went up and as interest rates went up? So is it a sort of a cyclical question for you?
Sure. To your first question about the appropriateness of the buffer, absolutely. The buffer is intended to ensure sufficient headroom in repayments for borrowers. And as I'd mentioned, the responsible lending obligations are intended to ensure borrowers are able to service their debts. And we think this combination of policy settings is appropriate and ensures that people are taking out loans that they have the capacity to service. And APPA, who are primarily charged with ensuring the stability of the financial system, have done an exceptional job at that. Australian banks are among the most resilient in the world. We've seen as events have unfolded in other jurisdictions that Australian banks have remained very resilient, and this is a factor of the prudential settings that APPA has applied within Australia. On the issue of reviewing settings, as I mentioned earlier, both APPA and ASIC do continue to actively monitor the market to make sure that their regulatory settings continue to be appropriate and are reflective of the current market conditions. in respect of home ownership, this is widely acknowledged as an issue of concern. House prices have escalated significantly in the period since the pandemic, and housing affordability continues to stretch people who are looking to get into the housing market and to purchase their own home. But as I mentioned earlier, we think that this issue will be best addressed in the long run by increasing supply, and particularly of affordable homes in the areas where people live and work. And that while there is a role to play in reviewing policy settings, we note there is an ability to provide exceptions to APPA requirements, and APPA does enable exceptions where it's managed prudently and in a limited way. But as prices have increased, this is an area we might need to continue to review and make sure it remains appropriate going forward.
So I'm just trying to understand the ABA's views on the serviceability buffer as they evolve. And you're quoted in the papers today, Mr. Taylor, is saying that APRA's buffer could be more flexible for first home buyers, adjusted for a borrower's circumstances and market conditions. And I'm just trying to understand what your sort of policy intervention is there. Are you saying that APRA should have a tiered serviceability buffer, a different buffer for first home buyers than it does for other borrowers?
No, Senator, we're not suggesting that. We think that the current buffer settings are appropriate on the whole. We're simply saying a discussion about whether the buffer might have a higher degree of flexibility for a particular cohort, being first home buyers, is worthy of having a further discussion about and further considering, ensuring that it strikes the right balance between ensuring people aren't borrowing more than they can afford to repay, and ensuring that by providing that flexibility, you're not undermining APRA's core mandate of ensuring that they are protecting depositors and ensuring the stability of the financial system. Against the backdrop of very high house prices, it's worth considering these measures in addition to the primary focus on increasing housing supply.
Okay, I'm trying to figure out what the view is, but in general, you think that obviously, you support the regulator and you support APRA setting the serviceability buffer, and you support the work that they've been doing, and you're certainly not suggesting that the Parliament should sort of weigh in and start setting serviceability buffers.
We're not suggesting any change to law, Senator. Look, this is a complicated issue. Australian banks are united in their view that supply needs to increase, and you'll see slightly different suggestions in the submissions about the ways to address supply and the best way to ensure that consumers can continue to safely access credit, but supply remains the key area of focus.
Last question.
And so, prudential settings like serviceability buffers should be set with prudential matters in mind, not necessarily the politics of an issue of the day.
Oh, that's the core mandate for APRA. I would note, obviously, there are policy interventions that often apply at both the state and federal level for first home buyers on the demand side, such as the first home buyer guarantee, which is intended to, or which enables a first home buyer with a 5% deposit to purchase a home without having to pay for lender's mortgage insurance. and effectively to get the capital treatment of having a 20% deposit. So there are measures that can assist first home buyers in getting into the market, and that's one example of one.
Thanks very much.
Thanks, Mr Taylor. Thanks, Chair.
Senator Pocock.
Thank you, Chair, and thank you, Mr Taylor, Mr Evans, for being here. I take from your evidence so far that prudential settings should be set with prudential goals in mind. And secondly, I think that's just been established that those settings, in your view, shouldn't be set by Parliament. I wanted to ask you about your broader constituency as an industry body. And I understand you've put your ABA view forward in favour of a reduction in the serviceability buffer, but not all of your affiliates or members support that, do they? I understand. Oh, correct me if I have this wrong, but today the Financial Review reports that the Commonwealth and Westpac, who are the two largest lenders by size, believe the 3% serviceability buffer is appropriate. And the NAB is in your corner, but others are not. How do you reconcile differences within your constituency on this issue?
So as I mentioned earlier, I think banks are united in the view that this is a supply-side problem and that the solution for increasing affordability for first home buyers will be addressed by supply-side measures. And each bank has also made, or many banks have made their own submissions as well on the ways in which they think that can best be achieved. Each bank also has its own approach to assessing loans, their own approach to allocating risk and their own pool of existing mortgages, and so they might have slight differences in the way that they approach these matters, but they each recognise that helping first home buyers into the market is an important area and welcome ongoing review and discussion about the most appropriate ways to do that from a policy perspective.
Let me just press you a little there, because you've come here today representing a reduction in the serviceability. I've absolutely heard you on supply, and I'm sure no one on this inquiry would be arguing about that. Supply is obviously critical. But when it comes to other issues, you represent a view which is at odds with some very significant lenders. And so I want to press you. They're in your organisation. I don't hear you representing their viewpoint.
So just to be clear, we're not suggesting a reduction in the buffer. What we're suggesting is it's worth having a conversation about whether greater flexibility is needed to ensure people can safely access credit based on the approach that each bank takes to making credit decisions. They may have slightly different perspectives about whether the existing exceptions that can be undertaken and reported to ASIC are sufficient, or whether there might need to be more enduring approaches taken specifically for flexibility for first home buyers. And that's all we're suggesting. We welcome the dialogue. You have several of the banks also appearing here today who may put forward more nuanced views on that perspective. But I think that's really a conversation we welcome having.
And thanks so much for clarifying that. So I hear you now saying, and I understand more clearly, that you welcome a dialogue, there needs to be talk about it, but you are not recommending a reduction in the serviceability buffer specifically. I want to go, you've emphasised supply and you've talked about some of these measures like the serviceability buffer, but you haven't talked about demand. And I'm sure you have an economics degree under your belt. One of the major drivers for housing prices is also demand. And according to a recent AFR article, housing investor borrowing is at its highest level in 2 years and certainly contributing to demand. What effect do you think that investor demand is having on house price growth in Australia?
Certainly. Well, we haven't provided a specific response on this in our submission. I would say, though, that the same dynamics that apply for first home buyers also apply in the case of investors who purchase homes to make them available for rent, and that the market needs to have availability of rental properties, and that supply is the overarching approach that should be focused on to ensure there are sufficient homes for people to both buy and rent. So continue to focus on supply as a way to address that, both of those housing needs.
What would be the likely effect of other approaches on this price issue? For example, the effect of restrictions on investor lending, such as APRA's 2017 restrictions on interest-only loans, and on the share of lending going to owner-occupiers. Surely they are also tools in the toolbox which would have an effect to assist first home buyers.
So APPA does have a range of tools that it has to intervene in the market if they have particular concerns, again from a prudential perspective, being a concern about risk in the financial system. They do have measures they can take to intervene. They have done that in the past in respect of investor loans, and they've had a degree of concern about the risk that they present from a prudential perspective. And as a result of those interventions, you will see changes in the market. So I think there's an acknowledgement that APRA's interventions do change the market, but that's by design, and it's intended to drive changes to risk through the prism of the prudential settings, and they've done that in the past, and that's widely understood.
So you've described the banking sector in Australia as the most resilient in the world. It's also, of course, the most profitable. And in terms of looking at profits by return on equity, what are the typical profits that banks make on mortgages?
I'm not able to answer the specific question at a granular level. What I would say, though, is that Australia does have a very competitive banking market. Net interest margins, which is the margin effectively between what a bank borrows money at and what they lend money at, has been declining over the past decade. 569,128 people refinanced their loan in the last 12 months, effectively looking for a better deal on their existing loan. And we think that competition is the best way to ensure consumers are getting the best deal, with nearly 72% of mortgages now being sourced through brokers who are incentivised to help customers find the best deal. We think competition is the right way to ensure customers are getting the best deal.
Thank you, Mr. Taylor. That was a neat sidestep, talking about declining profit margins. I'm actually looking at the figures or an answer that address the profit levels. How do rising house prices affect bank profits?
How much do rising house prices affect bank profits?
Yeah, and how do they affect them? Yeah.
Well, it would depend on the size of mortgages that are being written. Obviously, a rise in house prices for existing mortgages would have no impact. Obviously, you need to consider things like competition. As I said, there's a very active refinancing market. Mortgage brokers are constantly looking for customers to help them find a better deal and switch banks and find more competitive rates. So there are a number of factors that play in to the impact that will have on the rate that a customer is getting and the profitability that banks have on loans.
Last question.
Thank you, Chair. If the serviceability buffer was reduced, what effect do you think that would have on owner-occupiers and the house prices specifically?
Mm-hmm. One of the things that you do need to be quite careful about with simply focusing on demand side is precisely that concern, that there are demand side measures that can risk increasing house prices, which is why we suggest that these are things that should be considered in parallel, supply being the primary area of focus, and then ensuring that settings around the availability of credit are appropriate, and that they're sufficiently reviewed to make sure they continue to enable home buyers to safely access credit. But again, not harping back to the same point, but we do view this as a supply side issue, and that the difficulty is that with rising house prices, it is more difficult for first home buyers to save a deposit and to service a loan, and the primary focus should continue to be on increasing the supply of affordable homes.
Thank you, Chair.
Thanks very much. Thank you to the Australian Banking Association for being there today. And we now move to our next witness. Our next witness is Westpac. And I now welcome you to the hearing. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For Hansard record, can you please state your name and capacity in which you appear?
Good morning to the committee. My name is Martin Green. I look after the Westpac Group's property finance business.
Good morning. Thanks to the committee for having the opportunity to come and present today. My name's Paul Deal. I'm Head of Risk for the mortgage business and also accountable for credit settings across all retail lending portfolios.
Okay, thanks for being there. Do you have a brief opening statement?
Yes, thank you, Senator. And good morning, and thank you for the opportunity to appear before the committee today. This inquiry comes at an important time for our nation as Australia grapples with significant housing shortage. At Westpac, we are committed to supporting our customers in owning their home, whether they're a customer looking to buy their first home or a family looking to upsize or downsize. But we recognise that rising interest rates combined with increasing house prices have made the dream of home ownership more difficult. We believe the primary challenge facing Australia is housing supply. There are long-term and chronic structural obstacles that have made the cost and risk of building a house or a housing development unattractive for builders and developers. This has caused a flight to safety, whereby contractors, businesses and workers have redirected their skills and their workforces to areas like infrastructure building. Construction costs, labour costs and shortages, and planning and infrastructure costs are large contributors to this issue. These factors mean that the basic economics for building homes in Australia are currently severely challenged, if not broken. While there are other contributing factors, none of which are easily solvable, to effectively support home ownership, we must prioritise addressing these fundamental supply challenges. Despite these challenges, discussions on how to fix the housing crisis have often been disproportionately focused on demand solutions. From a Westpac perspective, we don't think the right answer is to put customers into more debt. We believe Australia's responsible lending and interest rate buffer settings have proven to serve our customers and the country well, particularly as we deal with this inflationary peak over the past 2 years. We do not believe that banks or the community should have an increasing willingness to accept high levels of home loan defaults. The 90-day delinquency rate is already higher for first home buyers at 1.23%, compared with the average homeowner of 1.1%. At the end of these percentages are young Australians who are going to experience hardship. In a challenging cost of living environment, we do not think it's the right to push up our customers' borrowing capacity to an absolute threshold. Owning a home is one thing, but we want to ensure our customers have sufficient discretionary income to live their lives beyond repaying their mortgage. To deal with the ever-growing problem, there are several supply-specific recommendations we've made in Westpac's submission to the inquiry to ease the housing shortage in Australia. These recommendations are focused on targeting government-backed support measures to developers and contractors of low to medium value residential stock and streamlining planning. In addition, a focus on addressing the labour shortages in construction is crucial. That is why Westpac is advocating for expedited pathways for skilled migration of building tradespeople to ensure we can meet the needs of the nation's construction building sector moving forward. In conclusion, Westpac is committed to supporting home ownership in Australia, as demonstrated by our participation in the Home Guarantee Scheme, which has assisted more than 15,000 Australians since 2023 in achieving their home ownership goals. By implementing the supply-side recommendations we highlighted in our submission, we can work towards a more sustainable housing market that supports all Australians in their pursuit of the home dream. Thank you for your time today. Paul and I look forward to answering your questions.
Thanks, Mr. Green. Look, we really appreciate you being there today. And I think, look, everyone agrees that supply is absolutely essential. So there is no great surprise there. But look, we are grateful. I'm grateful for your targeted recommendations about what we can do on the supply side. And so I do want to go to your recommendation on supporting pre-sales. So what exactly do you think is the change that would be required to get more pre-sales?
Yes, thank you, Senator, for the question. I think at the heart of the scenario is the great work that APPA and the banks have done together to become more flexible to support developers who are prepared to take more risk in projects where we can see the profitability and the settings are right. So we've come a long way over the last 4 or 5 years in working with the regulator to present more flexible solutions to the market. The core issue is that a developer will either choose to work with an Australian bank, ADI bank, or they will choose to work with a private credit operator. There's no shortage of debt to the sector. It's a matter of cost and whether they believe the Australian banks are flexible enough. So there's probably more work to do. But having said that, all of the Australian major banks, and Westpac particularly, are heavily committed to the development markets and are very active. So really it's about probably fine-tuning, Senator, rather than significant shifts which we made over the course of the last 4 or 5 years.
Okay, I understand, I think, the point you're trying to convey to us, which sounds to me like that you think there's regulatory arbitrage between the ADIs and private credit. Is that right?
Yes, they will take more risk generally, Senator, than the Australian banks. And it's not only pre-sales, there's a whole range of financial metrics that move towards how a bank or a private credit funder will behave. The Australian banks operate within fairly tight bands of each other. So we all actually operate at a level where we can see that each other are on very tight risk standards together. The private credit markets, unregulated, will take more leverage risk. They will take more market risks than the Australian major banks at the moment.
So what's the policy change you're wanting here?
I don't think it's a policy change. It's obviously probably just an opportunity to work with the regulator to ensure that we are all on the same page around where the bank would like to take more risk into the development communities.
Okay, so you don't want Parliament to do anything?
No, we're not asking the Parliament to make any specific change. No.
Okay, that's fine. Thanks for clearing that up. Then I want to ask you about the issue you flagged, your recommendation 7. So, are you saying to me here that there's a problem with the CDR data, getting access to it?
I'm happy to take that one. Martin,
thanks, Paul.
Yeah, no worries. No, I'm not. I don't think we're flagging that there's an issue with getting access to CDR data. I think what we're saying is that there'd be broader benefit if the depth of data and the level of data we have access to was more widespread, and that includes ATO data, and it also includes data through comprehensive credit reporting, such as account balances, interest rates, etc.
Okay, and then just for completeness, so I can be efficient with my questioning. And hand the call. So your Westpac's view is that there is no improvement that can be made to the credit rules. There's no improvement that can be made to serviceability buffers or anything else. That basically the system as we have it now, as run by APPA, is basically perfect.
We're supportive of the current responsible lending and the principles that underpin responsible lending. We're also supportive of the parameters that APPA set through their prudential standards. We're comfortable with the 3% buffer as it stands today. And I guess the thinking behind that is largely what it actually means for a customer at the end of the day. And so if we think through current parameters and what that actually allows a customer to borrow, you're effectively talking from a repayment point of view that it equates to about 40% of their net income at the end of the month that will be required to service the debt if they borrow to the maximum today. Now, generally across the market, most analysts would suggest that that's at a point that's indicative of mortgage stress or financial stress. We absolutely see that within our stats as well. And our view is that if we further loosen standards from where they are today, you'll only increase that burden on borrowers and create additional stress for those borrowers, particularly first.
So that's great. I mean, not many people come to Parliament saying that the laws that have been set are absolutely perfect and can't be improved in any way. So you're a great customer for us to have here at the Senate. So just to play that out a bit, so effectively your view is that even at the top of a tightening cycle, where you're probably issuing a mortgage at, I don't know, 6.5%, that APPA suggesting that it could be, as high as 9.5% under their 3%. You don't think that's diminishing the opportunity for any first-home buyer to get a loan with Westpac?
As I said, under the current policy parameters we have today, that'll allow a borrower a loan amount that equates to 40% of their net income to service that debt. At that particular point...
but it's a hypothetical, isn't it?
It is a hypothetical, and
hypothetical.
It comes back to your view on whether we think we're at the top of the rate cycle.
Do you think we are?
Internally, our view is that we are at the top of the cycle, and we expect the next move to be down.
Okay. Look, I completely respect your view. That's why we're looking at this, because it does seem a bit strange to have this hypothetical in place when clearly the evidence to the Committee from others has been that there are people who could get a loan here. They could service the loan, but obviously you think that the current arrangements are adequate and you're not recommending any changes.
Yeah, that's right.
Well, thanks very much. I'll hand the call to the Deputy Chair.
Thanks, Chair, and thanks both to being here for us. I think your evidence has been really clear in your submission, in your opening statement and your answers to the Chair. So, as I understand it, you've said that supply is the answer, and that's where the vast majority of our effort needs to overwhelmingly be. You've said that people taking on more debt is not the answer. It's not going to improve affordability, and it's going to put people at risk. And I think you've said that you don't support the sort of relaxing of the lending market, even being a focus of policy debate, because it potentially detracts from the focus on supply and from a united focus on supply. Is that broadly your key evidence today?
Yeah, I think that's a very good submission.
And so, just for the avoidance of doubt, this particular inquiry, and this is, I think, the second hearing, we've looked at questions around the serviceability buffer. We've looked at submissions around there being a 2 to 3% arrears target, so allowing more people to go into arrears. And we've looked at moving risk weightings on banks' books between first home buyers and established home buyers. So you're not supportive of those sort of measures to open up the lending market. And what do you, as I understand it, and what would the sort of the risks of pursuing that sort of strategy be?
Yeah, I think that's right. And if I start with risk weights, we do hold higher risk weights or more capital for first-home buyer younger borrowers. They do present as riskier loans. We do see higher default rates and higher hardship rates off the back, which ultimately results in higher risk weights flowing through. That doesn't necessarily feed through to a view as to we don't want to compete and we don't want to win that business. We're absolutely in the market to support Australians into their first home, and we want to make sure that they're successful in that particular journey. We've seen our composition of new lending increased circa 50% through FY24 for first home buyers. And I think you heard through the APPA submission that the overall market for first home buyers has increased fairly significantly over the last few years, and we've absolutely seen that. Off the back of that, we generally don't think that there's any constraints specific to first home buyers under the current policy settings, because we absolutely are seeing them enter the market, and we're seeing them enter the market more so than we have historically.
Can you just tell us a bit more about that? So the expansion of first home buyers as a proportion of your book, how has that gone over the last few years, and why is it happening?
Yeah, we've absolutely seen an increase through our FY24 period. It's just come to a close. We're up circa 50% in terms of proportion of new lend that's gone to first home buyers. So that circa 10 billion of new lending was given to first home buyers through FY23, and that's sitting at about 15 billion worth of new lending that's gone to first home buyers. A big part of that is off the back of the Housing Guarantee Scheme. And the support the government's provided through the Housing Guarantee Scheme. And we think that's done a really good job in terms of overcoming the deposit hurdle that borrowers, particularly first-home borrowers, face in getting into the market.
Yeah. And I noticed in your submission, Westpac's participated in the scheme since 2023. And in that time, you've increased the share of first home buyer market commitments from 20 to 25%, it says in your submission.
Yes.
And so you've been very clear that demand side policies are not the answer overall, that it has to be supply, far and away the most important thing we can do, address all of the constraints that you've talked about that we're all aware of. The home guarantee scheme, which, as you said, has been expanded with some extra government support, that seems to be a very effective demand policy, but that one that does not, in the way it's structured, appear to have any upward impact on affordability. Is that your assessment?
It's difficult to attribute at that level, but I suspect whenever you've got an initiative that looks to increase the level of people that can access the market, you're going to put upward pressure on prices. You will increase demand, and I suspect there has been some upward pressure, particularly in certain value bands that scheme focuses on. That has played through over the past 12 to 18 months whilst that scheme rolled out. So I do think it has potentially played through into higher prices. And I guess that brings us back to our initial position that kind of any policy focusing on the demand side is only likely to bid up prices further and result in us being in the exact same position we are today with borrowers who are locked out of the market with higher asset prices.
Yeah. So those sort of demand side policies can be sort of useful in assisting some cohorts into the market, but they need to be extremely tightly targeted if they're to operate effectively, and the overwhelming focus, as you have repeatedly said, needs to be on supply.
That's our view.
Yeah. Thanks, Chair.
Thanks, Senator Pocock. Do you have questions?
Thank you. Yes, I do. Thanks, Chair, and thanks both for being here. I just want to make sure I've understood you correctly. You're saying the right answer to the crisis is not to put more customers into greater debt, and you went on to say that first home buyers should be able to live their lives beyond paying their mortgage. I'm very strongly in support of that. But at the same time, you say the current parameters around average mortgage, average borrowing, average level of repayment means that 40% of the income of the average new mortgage borrower is to service their debt at present. Is that correct, that 40%? Have I named it properly?
That assumes that the borrower is borrowing to their maximum capacity. To the maximum.
And isn't the definition in Australia of mortgage stress that's widely accepted a 30% a portion of income going to mortgage out of pre-tax income?
There are various definitions, but yeah, it's widely accepted at 30%.
So more than half of Australians are in very serious trouble as they go into. They're under serious stress, I should say. And you pointed to the rates, the 90-day rate of default, which is considerably higher than it is for the average borrower for first home buyers. Is that right?
Yeah, that's right. I do think an important point just on the borrowing capacity conversation is that for the large part, our customer base don't borrow to the max. The vast majority don't need to borrow to the max. And I think that's also indicative of the current policy parameters not necessarily constraining lending either. If we saw a large proportion kind of hitting up against the max or borrowing to the max, I think that would be more indicative that the current policy parameters are constraining lending. But at the minute, 3/4 of our population borrow well within their means, which is an important stat.
First home buyers, what proportion of them are borrowing to the max?
Relatively consistent with the broader book.
75%.
Yeah.
So that is one of the factors, apart from compassion for the pressure it would put under people. That is one of the motivations then for you not supporting a change in the prudential settings?
I think it's a statistic that helps give us a view that that's not necessarily the issue.
Great. I wanted then to go to Westpac's own position and policy. We've got terrific banks, we're told this morning, and we've got, of course, we know extremely profitable banks. You made 7.2 billion last year, I understand. Considering that level of profit and your desire to see people out of stress, particularly first home buyers, do you think that you should be considering, or have you considered, waiving mortgage insurance for first home buyers and absorbing the risk yourself? Given that insurance actually buys you out of risk, it doesn't make any difference to the risk that a first home buyer is in.
That's a policy rule that we could absolutely consider, and it's an option available to us. I don't think I can answer now. There's a governance process around kind of building out policy, but it's absolutely one we can take on notice and discuss further.
And do you agree that offering that as a significant measure for first home buyers would give you a very strong competitive advantage, assuming not all the other banks followed you instantly?
Assuming not all the banks follow. But it is an incredibly competitive market, and a move like that would typically result in others following, I would suspect.
And is it time, do you think, for our big Australian banks, of which you're one, to share a bit of that huge profit with those who are really suffering out there in the mortgage market?
Yeah, I certainly think there are ways at which we can look at our lending standards to make it far easier for first home buyers to get into the market and support them through that journey.
Look forward to hearing more about those. Thanks very much for being here, and thanks, Chair.
Thank Westpac very much for your time and evidence today, and we wish you all the best. We now move to our next representatives, who are, I understand, the National Australia Bank. Let's give them a moment to appear. Okay, I now welcome representatives from the National Australia Bank. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, please state your full name and capacity in which you appear.
Andy Kerr, the Executive for Home Ownership with accountability for home lending at NAB.
And Ben Nichols, Executive of Portfolio Management within the Home Ownership team.
Thank you very much. Do you have an opening statement?
We do.
Please go ahead.
Thank you, Chair, for the opportunity to be here today. I'd firstly like to acknowledge the Ngunnawal people, the traditional owners of this land, and pay my respects to their elders, past and present. We have a problem right now. The great Australian dream of owning your own home is becoming more difficult. Last year's intergenerational report found that just 35% of 25 to 29-year-olds owned a home in the 2020s, compared to 55% in the 1980s. We're committed at NAB to helping those who aspire to own their own home to do just that. While we know this inquiry is focused on demand-side considerations, having adequate available housing is crucial. Demand-side policies, without a focus on making sure there are adequate properties available for buyers, risks exacerbating the current challenge. To drive meaningful change, we need to improve planning and approval processes to incentivise development and, of course, support collaboration across all levels of government. Focusing on supply is essential to addressing the root cause of imbalance in the property market and helping first home buyers into homes. Alongside finding a home, we know that saving for a deposit is also a significant hurdle for Australians getting into the property market for the first time. The government's Home Guarantee Scheme has been overwhelmingly successful at supporting these customers. Since 2020, NAB has been able to help more than 30,000 first home buyers under this scheme, including 11,000 this financial year alone. To give more people access to this scheme, NAB supports increasing the current income caps, which have remained unchanged since 2020. As we said in our submission, we also welcome the opportunity to work with government and regulators to consider how changes to the lending framework could help first home buyers, including how HECS debt is assessed and how a lower serviceability buffer for first home buyers could improve their borrowing power. Whilst we believe that the availability of housing is the fundamental issue, it's important that all options are on the table right now so we can meaningfully improve access to credit for Australians in a responsible way. Thank you, and I look forward to our discussion.
Thank you very much, Mr. Kerr. So how many home loans does the NAB currently issue?
We would issue around, we have a total number of home loans on our book of over 1 million. We would typically issue home loans of around $80 to $90 billion per year, with a total book of around $340 billion.
So about 1 million home loans. And how many of those would be issued to first home owners?
For us, we have around 12% of new home loans. That's pretty consistent with the number of first home buyers in our existing book, and that has been relatively steady over a number of years.
Okay. And do you think that the current macroprudential policies, particularly in the buffer, are impacting the ability for there to be more first home owners?
We think the buffer is an important mechanism to protect for changes in interest rate over time. And the rapid rises recently that we've seen over the last couple of years, I think are a good reflection as to why the buffer is in place and why the buffer is important. In our submission, we do see an opportunity to work with regulators and government in a targeted way to look at modest changes to the buffer for first home buyers, which would provide modest increases in borrowing power for first home buyers versus the broader population.
Yeah, fair enough. So you think that there could be a lower buffer for first home buyers, and that might help generate more first home owners?
We think that would have a modest increase on first home buyer borrowing capacity. We do think that any implementation of a change would require other consideration of other credit risk elements to ensure that it is done safely. Examples that we've included in the inquiry are debt to income, ensuring that we do not sort of stress people on a debt to income basis. But we do think there's an opportunity to explore that, noting it is a relatively modest increase in borrowing power versus some other mechanisms which we've also suggested.
So basically, if there was a reduction in the serviceability buffer for first home buyers, you think that some first home buyers might be able to borrow more money. But do you also think there's an opportunity for there to be some new first home buyers as a result of that change?
Well, we would see the opportunity clearly to differentially increase borrowing power would allow first home buyers to be able to compete for houses where they want to live. The recommendations on the buffer, we would say, are modest. We would need to work through the impact on that in terms of the number of new first home buyers that would avail. We note there are other issues. There has been lots of discussion already around supply. The other issue which the Home Guarantee Scheme plays well to today is the need for a deposit, and we also would recommend value in visiting the income caps there. So I think that we wouldn't see changes in a buffer as a silver bullet, but there is a modest opportunity there.
Is it your sense now that there are prospective first home owners that are missing out on that first loan because of the buffer?
I think, again, this is a pretty complex scenario, the extent to which it's supply side issues versus demand side issues. It's hard to kind of isolate, I think, to a singular problem, and hence why we've put a number of recommendations to explore.
Yeah, but you have recommended a tailoring of the buffer for first home buyers. I assume you're recommending that because your sense is that there would be people who are missing out on loans.
Yeah, we think that gives first home buyer more buying power than another owner occupier investor in the market.
Yeah, okay. So there are people who could be first home buyers that aren't being first home buyers because of the buffer.
That it would be one lever and one measure that could be getting in the way today.
Okay, well, that's very
again restate that there are multiple things that go into a first home buyer.
Yeah, certainly it's a very complex area, and everyone agrees that supply is the major issue here, but that's why we're having an inquiry to look at whether there are any opportunities for targeted changes on the demand side. So what about, what about on delinquencies? Do you have a higher rate of delinquencies amongst first home buyers compared to the rest of your mortgage book?
Our experience is that first home buyers are no more, no less risky than other customers. So first home buyers don't show up as high a risk in the NAB portfolio.
Okay, because of course, as we discussed with the prior witness, the buffer is a hypothetical. At the moment, it's a hypothetical where at the top of the tightening cycle, it is unlikely that full 3% would need to be invoked. So if there was a graduated scheme for first home buyers, your evidence is that there's no difference in delinquencies between first home buyers and other mortgagees. So I imagine then your view is that there is no great systemic risk if you were to have a tailored buffer for first home buyers.
Yeah, based on NAB's experience, we see first home buyers as no more risky than other customers that we help.
Yeah, okay. Can I also ask you about the capital risk weight? So how much capital do you hold against mortgages?
I might just...
Technical question, sorry.
Yeah, I might pass that to my colleague Ben, who has accountability for first line credit risk and all of our capital adequacy, to answer that one.
Thank you, and thank you, Senator, for the question. Our capital models will consider a number of factors across a customer and their type of borrowing. So there is not one standard credit risk weight held against all loans. To Andy's point, one of the highest drivers of credit risk weights is the risk of the end customer. And for first home buyers, we see them as no greater risk. As we think about the broader portfolio, the risk weights can be sort of between 1% to 3% of total loans held across the portfolio at an aggregate level.
So how much, sorry?
Between 1% to 3%.
of the
of the total portfolio. Yep.
Okay. So how much, you might have to take on note, but how much capital are you holding against mortgages?
We might need to take that question on notice.
Okay. But so that is determined ultimately by the bank on a risk basis, but there is still a formula you need to comply with, isn't there, under the prudential standards?
That's correct.
It might be useful if you just explain that for the record, because we are veering into quite technical territory here.
Certainly.
Sorry.
No, that's perfectly fine. So our credit, a capital risk weight model is calculated by the loan balance multiplied by the probability of default, how likely that customer is to go into arrears and ultimately default on that loan, multiplied by the loss that we may have as a result of that customer going into default. There are for major banks, there are scalars that are applied to that for more risky loans that are set by APPA. So that application applies to a standard owner-occupied principal and interest loan, and there are scalars applied for more riskier loans, things like interest-only repayments, investor loans. Investor interest-only loans have a scaled overlay, and so that may multiply the capital holding by 1 to 3 times the base amount for those higher risk loans.
Okay, and that's set out in the capital adequacy.
Correct, that's right.
Yeah. Okay, and I assume APPA changes this from time to time?
Yes, they do.
How often?
That can be driven by APPA. The most recent change was in 2023. There was a change to the capital adequacy models, which the industry has now applied.
Okay. So if APPA says that you have to hold a different type of capital weighting against a mortgage, how do you then respond in your pricing? How does that impact your pricing?
Well, ultimately, that comes through, has an impact on the overall return that we make on a mortgage, and that's how we would measure mortgage profitability. Additional risk weights would typically lead for a particular segment to higher prices. We see that today with investor lending and interest-only lending, where we will see pricing for those loans is higher to reflect, amongst other things, the additional capital that we hold, as well as different risk attributes and different losses. And then obviously that in its context is managed at an aggregate level, at the total level of capital that we hold as a bank.
Okay. So then if the regulatory capital requirements set by APRA said that you had to have a lower capital risk weight for a certain mortgage, then what would be the outcome there?
Well, for that customer set, that would go through all of our credit models. It would go through pricing models, but it would typically be balanced overall by the overall level of capital that we're holding. And so it would be typically unusual to hold less capital against one customer segment and not have that offset against other segments of lending. That would therefore potentially lead to higher prices for other customers.
Okay, so just so I understand what you just said one answer ago, so I think you said that if you have a higher capital risk weighting for a mortgage, then you have a higher price.
It is one consideration that goes into pricing, amongst others. Okay. Risk, the potential for losses as another.
Okay, but just generally speaking, if there was a higher capital weighting applied to a class of mortgages, what would the general pricing outcome be?
Well, I think we would typically hold more capital where we see more risk, and we would typically price for the risk. Okay,
and I assume that the reverse is true then?
Yeah, as an example, we would price a first home buyer, which for us shows up as similar risk attributes as another owner occupier at similar levels.
Okay, I really appreciate that. Thank you. I'll go to the Deputy Chair.
Thanks very much, Chair. Thanks for being there. Just closing off on that one, the credit risk weighting issue. So if, and this is something that we looked at in the previous hearing, if you had a lower credit risk weighting applied to first home buyers, you'd have a higher one applied on your books somewhere else. And so just to put that in human terms, that might be an ability to have a more affordable loan for a first home buyer, but the loan, the interest rates you're charging effectively would then probably be higher for some other parts of your book. And that could include, say, somebody who had bought a first home, it was a flat or an apartment, and then they wanted to upsize and buy a house, they would then perhaps get hit with a higher rate. Is that right?
Yeah, that's exactly right, and it's one of the reasons why risk weights was not in our recommendation to the inquiry. We're concerned that sort of artificial changes to pricing for first home buyer could lead to two unintended consequences. The first is at some stage later, a potential jump up in rate and rate shock. The other unintended consequence would be a flow-on impact to existing customers, which in a current already high rate environment with customers challenged, that's probably something we wouldn't want further unintended consequences. So we see it as a complex mechanism with a number of unintended consequences, where we see other levers probably simpler, less complex, easier to implement, but with less unintended consequences as a result.
Yeah, thank you for that. And then just sort of for the avoidance of doubt, we haven't spoken much about supply with you today. I think it was somewhat taken as a given that it's the biggest issue in relation to housing affordability, that, you know, supply and demand are currently not matched and we all need to work towards increasing supply. Is that your view, and is it what, you know, your insights tell you?
Yeah, it's absolutely our view. We think the biggest problem to solve is supply, and we would be cautious about pulling demand-side levers if they weren't complemented by supply-side interventions in parallel.
Thank you. And I just want to try and unpack the serviceability matters. Obviously, there's a bit of sort of interest in them, and that can sort of sway how the debate goes. And so I just want to try and just clear up what you are saying and what you aren't saying. So, you know, today there's a headline that says calls to reduce 3% home loan buffer test, and you know, your bank is quoted as, you know, sharing the view that we should cut the 3% buffer. Is that what you're saying?
We think there is an opportunity to revisit the 3% buffer for first home buyers. We think it would be a modest change, so we wouldn't be recommending a significant change, but a modest change would provide first home buyers with additional borrowing power. We would also be keen to engage regulator and government, but regulator in particular, to understand other credit risk overlays that we would put in place to ensure that any reduction in buffer didn't have unintended consequences. And as I say, one example, debt to income. There are other risk factors that go into our credit decisioning models, and so I think we'd want to make sure that we accompany any potential modest change on buffer with additional checks and balances to make sure that that we continue to lend robustly and responsibly.
And thank you. And in terms of lending robustly and responsibly, I guess there's different ways you could approach who controls, I guess, the serviceability buffer in a policy sense. And, it's APPA. It could be APPA, or it could be the banks themselves in another world, or it could be the Parliament, directly legislating them. It seems from your submissions you support the independent regulator, being in charge of those levers. Is that right? You support APRA having that role, but you want to sort of generate a discussion around how they do it?
We support, ultimately simplicity from a customer perspective, and simplicity, we find consistency is a key part of that. And so we do see one of the benefits of having a regulated buffer is it is applied consistently, and therefore much easier for customers to know what they're dealing with. And we would see a lot of merit in continuing that. We think it's it's not the bank's view, but a matter for government and Parliament, the role of regulator themselves. But certainly we see a consistent application of buffers provides a lot of benefit to customers.
So the buffer should be set by APRA, and more broadly, just for the avoidance of doubt, you support
we're not
prudential settings, and they've served us well.
Yes, we're not proposing any change to who sets buffer. We are suggesting there's an opportunity to have dialogue around for first home buyers, the extent to which we can look at a targeted, modest change to the existing buffer. Yeah, and just to further clarify, I think the ABA said, and they're on the record, and I don't want to misrepresent what they said in any terms, but I think they said their sort of approach was more along the lines of having one consistent buffer, but sort of flexibility in how banks apply it. You seem to be saying something slightly different to that, which sounds to me, and just an opportunity for you to clarify, sounds like a sort of a differentiated buffer. I think we're open to exploring all options, and I think all options need to be on the table. In our experience, consistency does help. That said, as we've kind of called out, other measures such as debt to income, other risk attributes, I think would almost certainly have to form part of it. So I think there will be some level of discretion in how and where that's applied. We are supportive of exploring options that are consistent, and that would certainly be our preferred approach.
And just finally from me, and switching gears just on to the HECS and help debt question, which you raised in your opening statement. The universities accord that was set up in that portfolio of government did suggest that policymakers and regulators look at the impact of help debts in home loan assessments. Do you have any suggestions on how to look at that, or how that could be modified?
Yeah, we have a recommendation in our submission. We currently have a very conservative approach to treating HECS debt. HECS debt is paid pre-tax. However, we look at post-tax income as our starting point for serviceability assessment, and then we are required to consider HECS as a standalone debt on top of that, and to some extent we see that as double counting in its treatment. Our recommendation would be to treat it as it kind of shows up for a customer, which is a deduction pre-tax, and we've laid out in our submission what we think the impact to borrowing power could be by treating it once and treating it consistently.
Right, thank you very much for your evidence. Thanks, Chair.
Senator Pocock.
Thank you, Chair. Thanks for being here. Can I go to the current level of borrowing for your customers? We've heard evidence this morning from Westpac that the vast majority of borrowers don't borrow to their max. allowable amount. Is that your experience also? And what proportion don't borrow to the max?
Yeah, that's a consistent experience that we have. So 80% of our first home buyers today don't borrow to the max.
Okay, so you've got 80% who don't borrow to the max. And in your submission, as I understand the discussion to date, you are asking for a revisit to the 3% buffer. Say there is a revisit to the 3% buffer, which I'm not in favour of, and I think we've had evidence from other people suggesting there isn't a case for it, but you're arguing should be revisited, presumably with a view to it being reduced, which will increase the size of loan available to first home buyers. 75% of or 80% in your case aren't looking for it. So is this a solution to a problem that doesn't exist?
I think there are lots of reasons why people don't borrow at capacity, and one of those is customer behaviour. To be confident that they are not putting themselves in a position that they feel too stretched. So the fact that customers can borrow to a certain amount, I think behaviourally we see customers don't always want to feel that they have pushed themselves to capacity. As it stands today, we present a position that includes the 3% buffer in the view of the total amount that we can lend, and given that is consistent, then customers will then apply their own judgment around that based on how it's presented.
And so they don't want to feel stretched, Mr. Kerr, and so they don't borrow to the max. So why would we make encourage the prudential regulators to increase the scope that's available to them when they're making very sensible decisions? I've made plenty myself, and I've got friends who do the same, not to stretch themselves. Why enlarge the borrowing capability when people know they can't manage it and they're not looking for it?
Yeah, look, we see that there's no silver bullet that is in place to help on demand side. We think this is one lever that could be considered. We believe it's modest in nature, and so we actually think the opportunity around HEX is more material in terms of the quantum of upside that it would provide. We also see problems with getting a deposit and the home guarantee scheme, and we see opportunities to increase access of the home guarantee scheme. So we see this as one lever. It is a modest lever that could benefit some first home buyers, but we wouldn't want the view to be that's the only lever that we think should be explored.
And I guess from a parliamentary point of view, what we do has to be better than modest, and it certainly has to be better than meaningless. We have to do things that actually make a real difference, and I'm not hearing the case in relation to the buffer. You point to other things that can be significant. Do you agree that under current settings, when people borrow to their limit at current rates, given house price averages and so on, that this means that 40% of their income goes to service their mortgage? We heard that evidence earlier today. Is that your understanding about how people land under current arrangements and settings?
Yeah, there are a number, but I think the 40% is yes a measure that's been used above which stress is considered.
No, 30% is actually the measure of stress. The current stats, the current interest rate settings, average mortgage size, average income, place. We have heard evidence. 40% of borrowers in mortgage stress, well above the 30% definition of mortgage stress. Is that your understanding of how the numbers work for people if they borrow to their current max?
I think there's a consideration of different numbers pre and post tax, and I might pass to my colleague Ben to just clarify the 30% and the 40%. Are they comparable, or are we looking at different tax treatments of those?
Thank you. And yes, Senator, just to sort of build upon that, our view of sort of 40% as a stress point would be a post-tax income calculation. I think you may find if you sort of back solve that to pre-tax, that arrives at a similar number to what you're talking about, 30% being a pre-tax.
I'm sorry, it's a 30% pre-tax definition as I see it in the literature. However, let's move on. Let's talk about NAB's circumstances in terms of profit. Last year, as I understand it, NAB made a $7.7 billion profit, a very, very healthy profit, very large in international comparison, putting us at the forefront of banks internationally. Are there ways in which you can share that profit with what we all recognise as extremely stressed first home buyers? Are you looking at measures which can assist first home buyers out of your own earnings and make a real difference? And amongst those considerations, would you look at mortgage insurance for first home buyers and absorb the risk yourself, given that there is a long-term significant profit to be earned from these first home buyers?
So we've invested as a bank heavily in the Home Guarantee Scheme. We were the first lender to participate in that and have been participating in that since 2020. That comes with additional operational costs, and it is a scheme that we've been very happy to invest in. I think it is a well-known fact that in recent years the competition for mortgages has been intense, and we have very publicly at times stepped back from the mortgage market based on the returns on mortgages in Australia. We have continued to support first home buyers throughout that, and have continued to support a similar level of first home buyers throughout. So we would say that right now you can look at our personal banking margins, and personal banking margins have reduced over time as a result of mortgage competition, and we would see that we are already not making the profit on mortgages that we have done historically, and the returns on mortgages that we have done through that competition.
However, Mr. Kerr, there is the evidence lies in the rates of profit here. We have 4 big banks in Australia who are making super profits by anyone's definition. And while you might want to point to a whip that exists in competitive brokering arrangements, there are very significant profits being made here. So could you go to my question, which is why wouldn't you, as a very profitable big bank, take on the risk of mortgage insurance for first home buyers who are really looking for a hand right now, many of them stepping into a mortgage well above the definition of mortgage stress? Why wouldn't a very profitable bank like NAB take on mortgage stress, which is just taking on paying for the risk for yourself? There is no benefit in mortgage insurance for the actual borrower, that first home buyer.
Yeah, we would see right now that with the returns in mortgages as they stand, with the accountability we have to multiple stakeholders, customers and shareholders, that's not an area that we would be looking to pursue. Where we don't hold mortgage insurance today, we are expected to hold higher risk weights, and therefore, as a result, those mortgages where we hold higher risk weights are by their nature less profitable and lower returning, and so it's not an area that we are currently exploring.
So what would be your prediction if the other big banks did take that risk over to their own balance sheets? Do you think NAB would be following?
Well, we think I would be worried about mortgage changes to mortgage insurance having inadvertent knock-on, similar to other levers that we pull to other customers, given the current returns on mortgages in Australia.
What is your rate of profit on mortgages and lending to first-home buyers?
That's not something that I would that we would typically disclose. I'm happy to take that on notice.
If you could take that on notice, I'm interested in it for first home buyers, for other owner occupiers, and the rate of profit for those investing in other forms of property.
Happy to take that on notice, Senator.
Thank you. Thanks very much. Thanks, Chair.
Thanks very much. Just before you go, Mr. Kerr, thank you for your evidence. It's been very helpful. Just wanted to clarify a couple of points. If there was a regulatory requirement to have a lower capital risk weighting for a certain type of mortgage, as exists today, as we just discussed before, through the APPA prudential standards. So if there was a requirement to have a lower weighting, just wanted to clarify what your position was. Was your view that it would be, generally speaking, a lower cost mortgage then for the consumer, or it would be the same, or it would be higher, or what was the answer on that one?
Well, I think we would typically see a balanced outcome that maintains overall capital for the bank. So we would expect any change in risk weights for one customer cohort to be absorbed by a different cohort of lending, and so our concern, one element is the unintended impact of that on existing customers. The other element is it's one factor amongst others that go into pricing of mortgages.
Okay, but is that how it works now? So if APRA says you have to hold more capital against investment loans, do you charge first home buyers more?
No, we typically, though, regulation, and I may hand to Ben to clarify recent changes, it would be rare for banks to overall hold less capital. So any changes would typically be managed with other changes to maintain the overall level of capital that we're holding. And these, capital changes are typically, risk weights are typically aligned to the risk of the borrowing itself, and per our earlier conversation, we see first home buyers as similar risk attributes to the rest of the portfolio. So in itself, we don't see that risk weights is a sensible mechanism. Plus, it's a more complex mechanism to try and drive a demand side change. Okay,
so when APRA makes changes to the risk weights for investment loans, do you pass that cost on to the rest of your book?
So we have seen in the past capital changes ultimately flowing through to pricing. And today, an investor will pay more for a home loan than an owner-occupier. And one of the drivers would be the risk weights. Another driver is the ultimate losses. Those would all flow through to different pricing for investors. As an example.
Okay, so if it's changed to 5% of the book, the rest of the 95% also has to pay.
We would expect that a reduction in one area would be offset by holding a similar level of capital, and therefore a risk of pricing being borne by other parts of the portfolio.
Okay, so just finally, so I understand this point. So when APRA has changed the capital risk weighting for investment loans, what impact has that had on the rest of the book that are not investment loans?
Well, the level of capital wouldn't have been changed on the other loans. So
it wouldn't have changed.
That's correct.
Okay,
but in that example, the overall capital being held is higher based on the risk of the increased risk of the lending.
Sure, but the rules are set by the regulator, right? The regulator sets the general guidelines of how you hold risk capital against mortgages.
That's correct.
Okay. Very helpful. Thank you very much.
Thank you.
No problem. Thank you.
We'll now move to our next representatives, and they are the representatives from Mortgage Distress Victoria, Consumer Policy Research Centre, Financial Counselling Australia, and Financial Rights Legal Centre. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Please state your full names and capacity in which you appear in the order as I said before.
Nadia Harrison, CEO of Mortgage Distress Victoria.
Erin Turner, CEO of the Consumer Policy Research Centre.
Dominique Mayrick, Co-CEO of Financial Counselling Australia. And Julia Davis, I'm the Senior Policy and Communications Officer at the Financial Rights Legal Centre.
Okay. Now, obviously, we're very grateful for your time today. Now, there's 4 witnesses here, so if you all have opening statements, I'll urge you just to be as brief as you can, because I know that my colleagues have lots of questions for you. So, really, a couple of minutes might be ideal if you can.
Thank you. I'm going to do the opening statement on behalf of the group.
Okay, great. Well, I guess that makes it easier.
Thank you very much for the opportunity to present and appear. The submission made by consumer groups represented here is focused predominantly on defending Australia's highly effective responsible lending obligations and our prudential lending regime, given the risk of devastating human consequences of any weakening to responsible lending obligations or a premature or knee-jerk reduction to the APPA prudential lending standards. Home loans which expose borrowers to debt beyond their means are financially crippling and emotionally and socially crippling. They're financially crippling given late fees, legal fees and the transaction costs of a forced sale. An irresponsible home loan can leave homeowner borrowers in insecure housing or homelessness, as well as additional debt. And they're emotionally and socially crippling. There's a well-established correlation between home repossessions, extreme mortgage stress and relationship breakdowns, family violence and mental health decline. And that's something that the team here at Mortgage Stress Victoria see on a daily basis. There are thousands of individuals and families behind each non-performing loan statistic, and any suggestion that we should target a higher arrears rate for homeowner borrowers would have a real human cost. We know our regulatory regime is working to prevent financial crisis and housing insecurity because the home repossession data demonstrates it. Responsible lending rules came into force in 2011 and the buffer increased, the serviceability buffer, which we've discussed so much this morning, increased to 3% in 2021. In New South Wales, the New South Wales Supreme Court, between 2006 and 2009, during that global financial crisis period, there were over 5,000 home repossessions each year. In contrast, with comparable hardship in this current cost of living crisis, with significantly higher housing prices. In 2023, there were only 1,413 repossessions, and in 2024, they're projected to be about 1,600. The Queensland and Western Australian court statistics tell a similar story. The Supreme Court of Victoria does not publish its statistics. We also know that the remedies available for irresponsible lending provided clear disincentives and a cost for harmful lending to banks. Regulators and government should exercise extreme caution in making changes to the buffer, given the human cost of unmanageable debt. The approach that APPA has taken to date demonstrates a cautious restraint and cognizance of the human impact of their decisions. We as a group have every confidence that they will continue to adopt this measured response, and I'm heartened to hear the wholesale support from industry for the regulator today and support for their role and their mandate to guarantee sector resilience. There is not a shortage of housing credit. There is a shortage of affordable housing. Housing credit grew by 5% last year and 4.5% the year before. And as Mr Taylor from the ABA said this morning, there are more loans being provided to first homeowners than the long run average. So we've got to be clear about the problem that we're actually trying to solve. As a group, we are sympathetic to the policy objective of trying to tip the scales in favour of first home buyers, but getting people into debt that they cannot afford is not the answer. As everyone has said this morning, the main game is housing supply. Any changes to the buffers or weakening of the responsible lending rules would be demand-side measures and could run the risk of further driving price increases. If the committee wants to help more Australians buy a home, it should focus primarily on how to stabilise or gradually reduce the cost of housing overall. I'll close by saying that in the midst of a housing crisis and a mortgage stress crisis, we as a group see an opportunity for a positive agenda from policymakers, which both reverses declining rates of home ownership and gets more first homeowners into the market, but also improves housing security and looks to the experience of homeowners for more consumer-friendly mortgage products. Examples of that ambitious agenda include Australians should have the option of US-style long-term fixed interest rates, tracker mortgages to protect homeowners who can't or won't switch from the loyalty tax that's charged for older variable mortgages, raising the bar, the regulatory standards for non-bank lenders, and consistent standardised hardship guarantees for extreme cases, so including family violence of mortgage stress. We would be happy to discuss any of these in more detail and happy to take questions. Please feel free to direct them to myself or the diverse range of expertise that we have in the room.
Yeah, thanks very much for your time and your efforts today. Can I just ask, are any of these organisations that are here before us today receiving government funding?
Yes.
Do you want to step through which part of the sprawling Commonwealth or states are funding you?
I'll start because mine's very simple. We are 100% funded by the Department of Justice, the Victorian government.
So you're the Victorian government, yeah?
Yep.
A combination of state government philanthropic grants for CPRC.
Yeah.
We are funded by the Department of Social Services, DSS.
Okay.
And financial rights gets about 30% of its funding from philanthropics, and the other 70% is a very complex assortment of state and federal funding arrangements for financial counselling, credit and debt support, and insurance law advice.
Okay. Okay, and basically your evidence is that the laws as they are absolutely perfect, nothing can be improved, and we should just go on our merry way and not have this process.
We would probably say responsible lending should be strengthened.
Oh, yeah? And how so?
Well, we have said for a while now that we think verification of expenses is something that lenders are not doing, and the Westpac case really showed that they can rely on standardized measurements. We think that that requires a change to the legislation to really strengthen how assessments are done.
Okay. Any other ideas?
I'm happy to step in here. Look, I'd say overall, there are a lot of levers the federal government has in order to address housing issues, but there should be an overall policy goal here of making the cost of the asset cheaper, or at least stabilising it, like was covered in the opening statement. We think there are a range of other measures that could keep people in paying their mortgages, just easing up the pressure on them. And that's things like long-term fixed interest rates, looking at how non-bank lenders are regulated, particularly how hardship is dealt with across non-bank versus bank lenders. There's a couple of recommendations we have that go to that.
Okay. Look, I'm conscious of time. I do want to ask you about this point of regulatory arbitrage. And I completely understand your position that you think that the current system serves people well. But what do you make of the development of the private credit market and where private credit operators are providing mortgages and mortgage-like products to Australians? I mean, this is effectively a much lower level of regulation. And if there is a extremely high level of regulation on one side, then maybe that is helping drive people into that market. Do you have a perspective on that you'd like to share?
I actually think you've summarised it well. There are definitely, I think, inconsistencies in the way that non-bank lenders are regulated. We see it most obviously in the way, say, obligations sit in terms of industry codes. The Australian Banking Association code, we think there's room for improvement, but it is, I think, the strongest code across the financial services sector. The Customer and Banking Association code is a little less specific in some areas, and there are fewer protections there. And then you get into the AFCA Financial Industry Code, which has only just been released in draft form, so it isn't in existence yet. And looking at that draft code, it is significantly less specific when it comes to the protections that someone has if they have a mortgage with an AFCA lender than they would with an ABA lender. Things like, we've pointed out, things like joint accounts and some protections that really matter. Say if someone's experiencing domestic and family violence, it really matters how a lender treats someone in situations like that. And they're going to get a very inconsistent treatment across different styles of lenders. I think there's a lot of sense in looking at how you can equalise regulation, whether that's through industry codes or through more leadership from a federal government. But there's inconsistencies that practically affect people. It's something, I'm not sure if Nadia, you want to jump in because you see it at mortgage stress.
Yeah, just to add to that, I think it is important to recognise the profile of clients that are more likely to be reliant on these non-bank lenders. You do get a cohort that do have poor credit history that don't necessarily have the option of going to one of the big four or one of the banks, and there is a poverty premium dynamic playing out to the extent that there are lower standards. And there isn't the consistent regulation that Erin described. People who can least afford to not have those protections are the ones that are saddled with the lower regulatory standards. So we think it's a really important priority of government to try and level that playing field and standardise those protections.
Thanks for that. Deputy Chair.
Thanks very much, Chair, and thank you all for coming here today and the joint submission made by Mortgage Stress Victoria and the Consumer Policy Research Centre as well. I think you started off by saying what we've heard already today, which is in order to address housing affordability, which is a big challenge for people, we need to focus on increasing supply, and that's the top issue, and particularly increasing the supply of affordable housing. And I think you've joined somewhat with Westpac, who said earlier that perhaps this is a debate that we really shouldn't even be having about relaxing our lending markets. Just a general sort of starting question is, as advocates, these debates have been going on in different forms for a long time. Relaxing the RLOs, the responsible lending obligations, for example, changing the prudential settings. Why do we keep coming back to this debate? And I guess just a general reaction from you about, whether it's the right debate to be having.
Can I just jump in on that one? The answer to that is I don't know, because what we're seeing is things that are in place that are keeping a crisis at bay, doing quite an effective job of that. I mean, we've seen a substantial increase in demand. We coordinate the National Debt Helpline. We've seen a substantial increase in demand over the last few years. We have also seen a real change in what the presenting issues are. So where previously you would have had personal loans, credit cards, payday loans, now we're getting a really sizable portion of the calls around mortgage stress, which is a big shift. So we're seeing sort of on a daily basis the both what it looks like when things don't go well, but also the recourse people have when they've been lent to irresponsibly. And so for us, it's so important that these protections are in place. We can see them in effect, and we can also see this burgeoning stress in the community, and also the really palpable effects of that. So, for example, frontline workers are reporting increases in suicidal ideation in callers. The levels of stress and the impact of being in that kind of stress are enormous, and we shudder to think what would happen if the existing protections were removed.
Could I just add that I think the reason we keep having this conversation is because it's a really easy fix that puts all the risk on individual homeowners, because fixing the housing crisis is really difficult, but a great way to keep the economy rolling, keep construction going, keep bank profits flowing in is to allow borrowers to borrow more. And we know that borrowers are willing to stretch and stretch and stretch because they are desperate to get into a house. And it is just, to be honest, a lazy policy idea that puts all the risk on the people who can least afford to manage it.
And I might direct this question to those of you who are at the front lines of seeing people who are in mortgage stress. What position are homeowners, on occasion coming to you in now? Because this debate has been very sort of technical in some aspects, but I think we need to know a bit more about what is actually happening to people out there who might be in mortgage stress today. And I guess what would happen if a parliament was to adopt something like a mortgage arrears target, which has been suggested in this inquiry by the housing industry, which would allow 2 to 3% of mortgage holders to be in arrears at any time. So perhaps sharing some of the current experiences you're seeing and what would happen if we did something, which of course I wouldn't support, of course, but to have an arrears target where more people are in arrears.
I'm happy to kick off, and I'm sure, Dominic, you might have something to add in terms of the National Debt Helpline experience. So at Mortgage Stress Victoria, we've included some very human case studies, examples, real-life examples in the submission, which I think do tell this story. But we see firsthand the interconnectedness between financial hardship and both family violence and mental health challenges on a daily basis. The stress of financial hardship can lead to exacerbation of mental health, including suicide ideation. Regularly, my caseworkers are coming across people making mention of suicide. And of course, the stress of financial hardship can exacerbate the tensions on relationships and also family violence. At the same time, the disruptions and trauma associated with mental health and family violence can exacerbate financial pressures through disruptions to functionality, reliability, participation in the workforce. A third of our clients are victim survivors of family violence. A third of our clients identify that they are challenged, that they are experiencing a mental health challenge, diagnosed or otherwise. We see families regularly who are going without fresh food and even skipping meals to get by. Home ownership to repossession for an unaffordable debt is both expensive and totally destructive to an individual and a household. Aside from those financial repercussions, the long-term disruptions to someone's financial well-being, there's the wholesale indignity of not being able to provide for your family. And as I said, the mental health and other broader health impacts. So these consequences are real, they're human, and they are multiplied far beyond what the kind of high-level delinquency statistics, which are really a sanitised version and don't adequately portray the lives that we're playing with.
I was just going to ask if
another question,
Dr. Merrick, if I pronounced that correctly, had...
Merrick, yeah, that's fine. Yeah, look, I did want to just add a couple of things to that. One is to say that since July, we've had over 42,000 points of contact to the National Debt Helpline, and roughly a third of those, the leading reason has been mortgage stress, but as Nadia set out, it's very, very, very rarely the only problem. So you're looking at people who are exhausted after years of pandemic, after natural disaster, who have been often now more frequently had a hardship arrangement in place, which is now expired, and they're still struggling. They're really at the end of the tether. We also hear lots of stories of people going without meals, certainly many situations where people are not paying, are unable to pay their energy bills, are unable to pay their telecommunications bills, are unable to meet the basic day-to-day. So the level of stress out there is extremely palpable, but also people are exhausted. People are already tired.
And so just finally,
last question.
Chair, I guess, and briefly, because as you can see, we're out of time. I mean, given what you're seeing, what would be the consequence of people increasing their debt to try to be in the housing market?
Risk and human catastrophe. Not in all cases, but significant increase to tragedy. That's not an understatement. As I think was alluded to earlier, Australians are very aware that one of the best and easiest way to kind of attract affluence is to get into the housing market based on the astronomical price increases that we've seen in the last decades. As a result, people are willing to really stretch themselves beyond what might appear sensible, and these laws are protecting people from themselves and the hardship for themselves and their families.
And there's
Senator
a real...
Senator Pocock, do you have some questions?
I do, Chair. Thank you.
Sorry.
I wanted to go to the issue that Senator Bragg raised, which is the funding source that supports the work that you do. Your submissions and your evidence is eloquent about the very sizable price paid by individuals for housing stress and default. And I have no trouble believing it, and it is a big burden on the public purse, of course, in our mental health system, in our domestic services, frontline, and so on. But is there an argument, or is there already in existence a levy on the super profitable financial sector institutions that are making money on the way? And of course, are many of them concerned about the impact on people who default? Is there a system of levy that supports your work?
No.
So why
you
not?
Go. Sorry, you go, Dominic. Sorry.
Sorry, for the financial...
Not a question for you. No is the perfect answer. Thank you. It is my view.
Sorry, but actually there is a qualification, sorry.
There is a qualification on that, in that there's a recently established industry fund, which has been, it's at the moment, it's a voluntary industry fund that will provide some funding to the financial counselling sector for frontline services. So just to say that is in train in a voluntary capacity, and we would love to see that expand and be embedded.
So just to be clear, we have the most profitable financial institutions in the world, extremely profitable, no argument from anyone. And we've heard from several players this morning who are reaping billions of dollars. And there is no compulsory industry level. There is an industry levy on the barley industry. There is an industry levy on the sheep industry. Why is there, is the question, and I'm not asking you to answer it, but it's an important question for us. For the public sector, so that there is an appropriate non-voluntary means of supporting the important services that you provide. So thank you. I will think about that in relation to recommendations out of this report. Your evidence is very clear about the cost, as I said, of the damage that arises from loss. I wanted to ask you about supply. Everyone is in extraordinary agreement about supply as the long-term solution and reducing the asset price, as you put it, for those who approach the market. We talk about supply so far as if it is a homogenous product. If I look at the stats on population, over the last decade, we've had a 15% increase in population, but we've had an increase in dwellings of 19%, and prices have increased by 75%. So it's not just about building and having dwellings. We actually have a lot of growth in dwellings over the last decade. We have got a certain composition of demand. A lot of them, I'm asking you to comment on my thesis here, are going to investor properties and to investor buyers, some of whom rent and some of whom build, but many who do not. They buy existing stock, and that certainly has an impact on price. And we don't have growth in affordable housing. And is the question of affordability critical here? I see you nodding. I'd like to hear you speak to that.
I think there's a really legitimate question about how you tip the scales in favour of first homeowners as against investors, and deal with demand from the other perspective, affecting demand on investors rather than stimulating demand from first home owners. Now, it's outside of my area of expertise as a Mortgage Trust Victoria, but I will highlight one recommendation, the final recommendation in our submission, and Erin is probably best placed to speak to this one, but what it's saying is in relation to investors, you have this absolutely outrageous situation where investors are not assessed when they take out a home loan on their capacity to actually upkeep a rental property. So if they can't fix mould or the other things that minimum dignified standards of housing we should insist on in Australia. Introducing mandatory regulations there would actually have the effect of dampening demand from investors, thereby changing the relativities in terms of demand from first homeowners. Erin, would you like to elaborate on that?
You've covered it beautifully. I do think there's some room for evolution in our financial regulation. We don't just want investors, we want good investors that will be good quality landlords for people who rent. And an investor that can't afford to fix an oven when it breaks is a bad landlord. We think there's some simple changes in here around looking at, say, the regulatory guidance that ASIC issues. It's currently not specific enough. It doesn't explicitly require lenders to consider if someone getting an investment loan has to have a reasonable plan or a reasonable, availability of funds for very reasonable expectations of maintenance and repair, something you could peg to the age and the quality of the property. I know that the quality of rental discussions, that's largely a state government issue, but when it comes to how loans work and feed and drive certain behaviours in the investor market, there is something here.
Thank you. Very important. I wanted to hear your thoughts then. I come from a state which in the post-war period under a Liberal Premier built thousands and thousands of public houses and affordable houses, enlarging the rent pool and really keeping most South Australians out of housing trauma. It's very different now. Our parks are full of tents. What is your view about a public builder? The Greens target is for 610,000 houses need to be built that need to be affordable over a decade. What's your view about the role of the public sector in ensuring enough affordable houses are built?
You go, Erin.
Look, I will say this is probably outside of our deep areas of expertise as consumer advocates. There has been a big shift over the past few decades where there is fewer and fewer publicly available properties, fewer community and social housing as well. We cannot expect the private rental market to continue to deliver most of our housing needs if we're looking at the rental sector continuing as it is. I do think whatever conversation we're having, we need to look at things holistically. It's not just about helping first home buyers into the market. That's really important. It also has to be about how are we helping people in the private rental market or people who can't even get into the private rental market themselves.
Okay, so final question. Thank you, Chair. I can see you looking at me. My summary then of what you've told us is the price being paid by defaults is huge and on multiple fronts, personally and for our public purse. The changes in the serviceability buffer that would enable people to borrow more are on the wrong track. Increasing risk and debt for poor people is not the solution. Instead, it is about building more supply, but a supply that is affordable, that is available to lower income people, and there is a big role for the public sector in that. You're all nodding, so I'll take that as I've heard you well. Thanks very much for your evidence, and thanks, Chair.
Thank you, Senator Pocock, for your innovative approach to talking to witnesses. And we now thank you for your time and evidence today, and move on to our next representative, which is the Commonwealth Bank of Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your name to capacity in which you appear?
Thank you. Good morning. Angus Sullivan, Group Executive for the Retail Bank at the Commonwealth Bank of Australia.
Good morning. Kylie Rickson, Chief Risk Officer for the Retail Bank for Commonwealth Bank of Australia.
Very much. Do you have an opening statement?
Yes, thank you. Thank you for the opportunity to appear before you today. The Commonwealth Bank Group is the largest lender to home buyers and to first home buyers in Australia. In the evidence presented to the committee, there are common views around several key priorities. It's been well covered. Housing stock is constrained and more homes need to be built. Homes need to be built in desirable and suitable locations, protected from extreme weather risk, with good access to public infrastructure, social amenity, and at a variety of price points. As we've said before, if we had 100 units of effort to solve this problem, we would put 98 of them against stimulating housing supply. With that said, there are questions about how we can do more to support more Australians to buy a home. Our research indicates that young Australians remain incredibly enthusiastic about buying a home, but many are understandably frustrated by their inability to enter the market. Our view is that the regulatory constraints which apply today are on the whole appropriate and reasonable. These constraints speak to achieving several important and at times competing objectives. First, it is essential that the integrity and safety of the system as a whole is protected. We have benefited in Australia from prudent policy settings and a strong and stable banking system. This means that we can access offshore funding at times through the cycle, and we're able to support customers just as we did during the COVID pandemic. Secondly, it is clear that the interests of individual borrowers need to be protected, as per your previous presentation. It is a poor outcome for consumers, banks, and the community more broadly if loans are extended to too many individuals who cannot afford them reasonably. Third, healthy competition between lenders is essential and delivers both innovation and fair prices for consumers. As has been widely reported over the past 12 to 18 months, mortgage market competition is intense. Within these regulatory constraints, a range of support is available to assist specifically first home buyers into the market. We can, for example, lend at relatively higher loan-to-value ratios, which reduces the size of deposit required for a first home buyer when we rely on lenders' mortgage insurance for customers who do not yet meet their deposit requirements. CBA also supports first home buyers through partnering in the delivery of government schemes, including the federal government's home guarantee schemes, which remove the need for lenders' mortgage insurance. A number of further suggestions have been proposed throughout this inquiry, and I would like to briefly provide our views. Firstly, on serviceability buffers, the buffer is not just for interest rates, but is forward-looking across several dimensions, including unforeseen changes in a borrower's income and expenses. Forecasting future interest rates movements is challenging. While there is a widespread view that we're at the top of the interest rate cycle, the future remains uncertain. The buffer is ultimately a matter for APPA to consider, and we have every confidence that they will review the options carefully. Secondly, on HECS, we have genuine empathy for first home buyers who have invested in their education, have taken on HECS debt, and that in turn reduces their borrowing capacity. We are bound by our obligations to protect consumers and lend responsibly and ensure that we do not lend them more than they can repay. This means we need to factor in all incoming and outgoing payments, including HECS debt. At the margins, we do have room to do more for first home buyer customers with HECS debt who are close to a serviceability pass, and we will consider these matters and do today on a case-by-case and exception basis. Finally, in relation to the capital framework as it applies to banks both large and small, we're open for a conversation about how these arrangements could be improved, and again would suggest that APPA is best placed to make these judgments. We urge a discussion that focuses on ensuring that the underlying capital requirements remain connected to the risk of the loan, and that is especially the case with first home buyers. These are important questions which are not just economic in nature, but go to the social fabric of Australia. Fresh ideas are worthy of debate, and we look forward to your questions. Thank you very much.
Okay, thank you very much, Mr. Sullivan, for your contribution this morning. I'm just going to ask you a few questions, then hand to my Senate colleagues. So I think there's been some reporting of your recent lending practices that, in fact, you've written twice as many loans for people earning more than $500,000 a year than you have for people earning under $75,000 a year. Is that right?
Yes, those numbers I think are in our latest reporting materials, and they are accurate.
Well, it sounds like we're becoming a nation where you've got to be a rich person to get a loan.
Look, I think as I mentioned in my opening remarks, at the core of the challenge we see here is that a home is expensive for many individuals on lower incomes trying to enter the market. And as a result of fewer lower income individuals being able to secure an affordable home, we see a skew in the profile of income distribution towards higher income earners.
Well, clearly a massive skew. So to what level would you say there is a connection between the cost of regulation and providing mortgages to the average income earner?
Look, I think, you know, it is one of a range of factors that drive the cost of the mortgage. Obviously, the cost of cash is a very material factor where we sit in the interest rate cycle. There are operational expenses. There are risk costs, you know, the cost of delinquencies. And obviously, as I think you've covered a little bit this morning, we can talk to it. The cost of capital is a factor. From our perspective, those costs do pass on to customers by segment. First home buyers are, with the data that we have for our bank, first home buyers are higher risk. They experience higher delinquency. I think that jibes consistently with the evidence that you were just presented by folks speaking from a customer advocacy perspective. And as a result, we think it is appropriate that the level of capital for first home buyers should be reflective of the underlying risk of originating loans for that segment of customers, and to make sure that we protect customers from taking on more debt than they can reasonably manage.
So what is the percentage of loans you have issued to first homeowners?
Over the last 2 to 3 years, it varies between around 10 to 12% of the total proportion of loans that we write in a year.
10 to 12%, okay. And so in relation to the buffer, which clearly is a hypothetical, I understand your evidence is that you're not sure we're at the top of the tightening cycle. I think most reasonable economists would say we are close to the top of the tightening cycle. It is putting another 3% on top. Do you think that there are any avenues there for this to be examined to help first home buyers get that elusive first mortgage?
Look, as I mentioned in my opening remarks, I'm very empathetic to people wanting to get into their first home. And obviously the bank has an interest in helping customers buy a property and enter the market. In consideration of the appropriateness of the buffer, obviously, first and foremost, it's an issue for APPA to consider. But from our own perspective, we look at the buffer as a prudent and appropriate measure that ensures that first home buyers, but all borrowers, do not overextend themselves. And the data, I think, adequately evidences that first home buyers experience higher levels of mortgage stress. That is true for our portfolio today. And that they struggle to get into the property market because of the high cost of property, and supporting them with more borrowing in light of those two facts, I think, is a difficult solution to the problem.
I guess the question is that, though, are there people that could service a loan but can't get a loan because the serviceability buffer is at 3% right now towards the top of a tightening cycle?
I mean, look, if you just looking narrowly at the buffer, yes, you know, the level of the buffer, wherever it was set, if one wanted to increase it from where it is today, there would be less people who would qualify for a mortgage. And if you decreased it, there would be more people who qualified for a mortgage. But I think, to my previous comments, we believe that the settings today are appropriate and balanced, especially between the interest of consumers and protecting them, ensuring that they don't take on more debt than is reasonable for them. It would, obviously, the bank has a commercial interest in lending to people, but we don't believe that that is the crux of the solution.
And the prudential settings are just one of a number of factors that go towards borrowing capacity, including the overall level of interest rates, customers' expenses, and the price of housing, of course.
Of course. So your view is, as a house, is that the 3% serviceability buffer isn't worth reviewing or looking at whether it could be more dynamic?
We believe the prudential settings today are appropriate and balanced.
Okay, so your view would be then that the way the APPA is doing it is good, and that I don't want to verbally here, so I'm asking you. So, are you happy with how APPA has run the serviceability buffer over the medium term?
Look, as I said beforehand, we feel the settings today are prudential and balanced. I have every confidence that APRA review them on a regular basis. They have made changes to the buffer in the past, and I'm sure they're giving consideration to all of the factors at hand and all of the outcomes that the buffer drives.
Okay, so if I said to you that there was going to be a 3% buffer when the official cash rate is 1%, but it'll be the same when it's 4.25, or I'd say to you, well, I'm going to have a dynamic approach, and it will move around based on market impacts and the official cash rate. I mean, would you have a preference?
Well, I think it's already been evidenced by the changes in the buffer historically that APRA has taken a dynamic approach to managing the buffer. There's been adjustments to it over time, and
it also works in conjunction with the interest rate serviceability floor as well, which was set by APRA but is now set by banks with oversight by APRA.
But do you think,
so at the moment that is
sort of roughly a review?
Look, I'm sure that APRA are reviewing it all the time. That they've made changes in the past, and I'm sure that they're giving it consideration.
Okay, we'll ask them about that. Now, what's your point about HEX and the buffer?
Look, on HEX, it's not directly connected to the buffer. On HEX, we understand for young Australians who've pursued higher education and the opportunities that hopefully that provides for them in terms of increased income, that it could feel like there's a little bit of a penalty from taking on higher education when it comes to then getting a mortgage afterwards. Now, the guidelines within which we operate today are very clear that we need to give consideration to HEX debt ensure that we include it in the serviceability calculations. The example that I was furnishing beforehand, we do see first home buyers who come to us with a HEX debt, and we do have within the framework provided to us by APRA the potential to give exceptions to the sort of the standard approach of assessment. And for example, if we had a customer who came to us who was within 12 or 18 months of finalising and completely paying off their HEX debt, and without that debt, they may pass serviceability today, we could and do and can extend discretion to write that loan as an exception within the framework that exists today.
Okay. So you're not recommending any changes there? Okay, fine. Sorry, I misunderstood you. Let's go to this last issue then about the capital weight. So if there was a lower capital weight for a particular class of mortgage, what impact does that have on the pricing?
Yes, maybe to the comments beforehand, I'll try and do it in the simplest way as possible.
Well, it's not an easy topic, Gary, so you'll be able to appreciate your efforts here.
I'll do my best. All other things being equal, if the risk weights were reduced and the capital that the bank needs to hold decreased, that would reduce the costs of providing that mortgage, and we would expect over time that would flow through to customers in lower prices.
Yeah, and so does one change in a particular class of mortgage risk weights impact other classes of mortgages usually?
Not for CBA.
Yeah, okay. And if there was a market, this is my last question, I'm conscious of time. If there was a market dynamic where one bank was passing on a lower price mortgage because of a lower capital risk weighting, would other banks feel that they need to respond to that, or would that not have that impact?
At the most fundamental level, I think what you'd find in many competitive markets, and the mortgage market is competitive, that when there's a reduction in input costs, some organisations will compete that new margin away in order to write volumes of loans that they'd like to write. So I think what I'd expect, and the mortgage market is competitive, that if there was a reduction in capital weights for a segment of customers across the industry, that we would see across the industry a reduction in prices for that segment of customers.
I mean, the other point I would make is that if that was in the order of 0.2 to 0.25%, that while that would be a significant amount of repayments over the course of the entire 30-year loan, that would be on an average loan about $70 per month difference and a borrowing capacity of between $10,000 and $15,000 more. So, it is marginal in a sense, dealing with the size of the problem.
Thanks very much. Deputy Chair.
Thanks, Chair. Thanks both for being there. I'll be pretty quick just in the interests of time. And I think that your evidence is consistent with evidence that we're getting in the course of this inquiry and that we're getting in a number of Senate Economics Committee inquiries that pertain to housing, as I understand it. And that is really that, number one, supply is the solution to moderating house prices and making housing more accessible to more people. Is that your evidence that supply is the answer, all day, every day?
Yes, as I mentioned in my opening remarks, I think if we had 100 units of effort to deploy, we would put 98 of them against solving the supply side constraints.
Thank you. And you don't think that there's a case to change APPA's prudential settings in relation to this issue of housing affordability?
No, we feel that the settings today are appropriate and prudent.
Thank you. Thank you, Chair.
Senator Pocock.
Thank you, Chair, and thanks for being here. Can I just follow up something from our previous discussion with those who are dealing with the fallout of defaults, which is, extreme hardship, and I'm sure as bankers you have seen it, as do many of your the employees in your organisation. What's your view about a levy to fund those services which remediate, assist those who are damaged by default?
I had the opportunity to listen to the session beforehand. I have met both Dominique and Erin before, and I think they do, as I'm sure was evident, exceptional work. I have visited Dominique in Melbourne, and I have sat on their telephone lines answering calls from customers who are in distress, and it's extremely impactful to hear the human impact. I think they were right in saying that one can look at numbers, but behind each of those numbers is a human story. We do already make a contribution to the National Debt Helpline to support their work, and we have worked with them over a number of years. We also do additional work to support our customers who are the victims of domestic violence, to give them a new start when they exit out of a violent relationship, to provide them with support and financial support, as well as employment support and other support. So, we feel that we make a very important contribution today, and we're very open to discussing with them more what we could be doing that helps them in their important work.
I guess what I'm asking is not so much a voluntary contribution or even a philanthropic contribution. I'm the daughter of a sheep farmer. Everyone who produces a bale of wool or grows a bag of wheat makes a contribution to their industry fund. That fund looks at problems and issues in the industry. In the case of finance, it would be the problems and issues that arise from default or risks and so on. And why I'm gobsmacked that there is no such levy in the finance sector, where the price of something going wrong is so high and falls very clearly on the public sector. So what is your view of shifting from a voluntary scheme to a national scheme which helped the industry contribute to responding to the challenges that arise when risks fail, when people get into trouble?
Yes. Thank you for the question. Look, obviously the bank does pay a deposit levy to government. I'm not suggesting that necessarily is the be-all and end-all of the contribution that we make, and we do pay substantial taxes. I believe, and I'll follow up with Dominique after this session, I do believe that we have a very constructive relationship with them and we are actively engaged with them. So I personally don't feel that there's a imperative to mandate what's already happening voluntarily.
And what about across the sector? Clearly not every organisation is doing that. As I may be wrong, perhaps everyone is, but is that something that you believe the entire industry, all, for example, 21 affiliates of the ABA should be contributing to?
I don't know what other institutions do to a sufficient level of detail, but I would be 100% supportive of all of them being supportive of the work of the National Debt Helpline and other organisations like them.
Thank you. The profit last year, I understand, in the Commonwealth was over $10 billion. What about a contribution on another front out of that profit, recognising the extraordinary circumstance of the housing crisis that we are in? We have a small fund at present, federally, that gives some mortgage relief to a small 30-odd thousand people. Obviously makes a difference. We've heard evidence that means, more people have gone into purchasing a home with assistance, the first home buyers, but clearly a very small number of people assisted. What about, given that the mortgage insurance arrangements are really to meet the risk of the bank, not the risk and consequences of a default to the borrower? What about waiving a mortgage relief more widely for first home buyers? Why wouldn't the Commonwealth Bank consider that? And would you?
Thank you again for the question. We have looked at our lenders' mortgage insurance offering a number of times, and the cost of that product to customers has reduced over the past couple of years in an effort to drive down the costs and make it cheaper and more affordable to customers. We understand that it is a cost when people are stretching often to get into their first home. That cost is a real cost. Obviously, there is. I know another bank spoke about their first home buyer portfolio not being higher risk. Our first home buyer portfolio is definitively higher risk. It has an arrears delinquency rate approximately double that of our portfolio. So there is a real risk that needs to be managed. We think that the lender's mortgage insurance is an effective way of doing that today. It does mean that we lend more volume of loans to first home buyers who do not have the deposit necessary to get into the market. And over the years that's operated, that has supported a lot of people getting into the market who might not otherwise be able to do it. To your question directly, I think it's been widely reported that the mortgage market is highly competitive, including many periods of time over the last 18 months where we have been writing mortgages below the cost of capital. First home buyers are a higher risk customer segment within that, so all other things being equal, they would be lower profitability than the portfolio. And so my view is that we do a lot to support this segment today with our offerings that exist in market, from LMI all the way through to the home buyer guarantee schemes that we've supported very strongly over the years.
Just following, yes, thank you. I asked earlier on notice other witnesses, could you supply to us on notice your rate of profit on first home buyer loans to other owner occupiers, and the rate of profit on those investing in housing? And yes. Thanks so much for your evidence. Thanks, Chair.
Thanks very much.
Thank you.
The committee will now suspend until 12:50.
Thank you.
representatives from the Australian Financial Complaints Authority. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Please state your name and capacity in which you appear.
Yes, thank you, Senator. My name is David Locke. I'm the CEO and Chief Ombudsman at AFCA.
Dr. June Smith, the Deputy Chief Ombudsman at AFCA. And Natalie Cameron.
Sorry.
Oh, apologies. Natalie Cameron, I'm the Lead Ombudsman for Banking and Finance at AFCA.
Do you have an opening statement?
Yes, a brief one, Senator. We welcome the opportunity to appear before the Economics References Committee today. As you're aware, the Australian Financial Complaints Authority is the Australian Industry Ombudsman Scheme for the financial services sector and a not-for-profit organisation. Our role is to independently resolve disputes that consumers have with financial firms, and in doing so to identify systemic issues that may arise and serious contraventions of the law, and to report those to the relevant regulators. The primary touch point for AFCA in policy debates about home ownership relates to consumer credit and consumers' experience of the credit products they purchase to buy their homes. And we see this through the complaints work that we do and also through the systemic issues work. We recognise that it is important that consumers can access credit products that meet their needs, and it is also important that the risks and downstream social and economic impacts of unsustainable debt are mitigated. Through our complaints, we see the real-world impacts of poor lending practices and unmanageable debt on consumers. The result can be devastating and overwhelming for people and create lasting hardship impacting families and communities. AFCA is currently seeing an overall increase in banking and finance complaints year on year. We're also seeing a significant and concerning increase in complaints involving financial hardship. And this is particularly where a hardship request has been declined or where there has been a request to suspend enforcement proceedings. And home loans are the most complained about product for consumers in financial hardship. Based upon our data, we observe that many consumers are struggling to meet existing lending commitments. Throughout this year, we have been urging lenders to lift their game when it comes to their responsiveness to hardship requests. In contrast, the number of complaints relating to responsible lending has actually been relatively stable. The key drivers for this include responsible lending obligations, as well as concerted efforts and uplift in standards on the part of the banking industry following the Financial Services Royal Commission. AFCA would be concerned about any weakening of current regulatory settings for consumer credit, which we believe could expose consumers to greater harm and long-lasting hardship. We're happy to take any questions.
Deputy Chair.
Thank you very much, Chair, and thank you for being there for us today. You've noted in your opening comments and in your submission that there is, unfortunately, a rising number of complaints from mortgage holders seeking hardship assistance. And you've said that, lenders really need to be helping people when they are facing difficulties with their loan products. What are these complaints broadly about, and what do they indicate to you about the level of stress that might be out there?
Yeah, I'll let my colleague answer.
So our financial difficulty cohort of complaints includes hardship complaints, and we saw a really concerning increase. As mentioned, it's an 18% increase last year, and that's on the back of a really significant increase the year before. So these are certainly increasing. The type of complaint we see is, first of all, a failure to respond to a request for hardship assistance, but that cohort has remained relatively stable. What's really picked up in the last 12 months has been complaints about a request to suspend enforcement proceedings and also about the reasons for a decline of a request for help. So really people are moving through the process to the enforcement stage, and then they're coming to AFCA for help if they're having an issue with that process.
Thank you. And
ASIC issued a report 782 in May of this year, where they did a deep dive into the hardship practices of a number of major lenders. And actually the report, it's a detailed report, and really it very heavily resonated with what we're seeing through our casework. So what they found was that about 1/3 of people who applied for financial hardship found the process so difficult, or the hurdles put in their way so difficult, that they actually abandoned the application process. They also found that a significant number of people were provided with what we would call like a sort of cookie cutter response, so a standardised response that might be a mortgage payment holiday of 2 months, and that was really what was being offered consistently across the piece. And what they actually saw was many people who were getting these sorts of responses, it wasn't addressing the substantive issue, it wasn't giving them a pathway forward, and they were defaulting straight afterwards. So it shows that there's very different practices amongst different lenders, and I know ASIC have given particular feedback to individual lenders, but it does show that there's much more work to be done in this space.
And your evidence and the ASIC report that you referred to really send a pretty strong message to the banks that they need to do better in how they manage these hardship requests. And the fact that you're getting more complaints about them, does that indicate to you that the levels of hardship are also increasing? Is that a sort of a fair extrapolation?
I think it is. I mean, the 18% increase that we've seen in the period up to the 30th of June is clear evidence of that. And what we're seeing, and as we said, the largest product area for financial difficulty is home loans. That accounts for 32% of the complaints that we're seeing, followed by personal loans and then credit cards, but home loans are the most significant area. And I think what we're seeing is people are doing their utmost to maintain the mortgage payments. You know, this is the last thing that they're sacrificing other things, and they're taking out other forms of credit in order to be able to manage the mortgage payments. But we've seen increases, for example, in complaints about buy now, pay later, about unsecured lending, a whole range of other areas. And for us, even around credit references, and for us, all of these are indicators of stress in the market and indicators that people are seeking other forms of credit and trying to maintain the home loans. I think where we've seen periods of sustained high interest rates in the past, one option open to people has been, of course, to sell the property and to move into the private rented sector. With rents so high, actually that is often not a solution for people, and the housing costs would be greater than even the mortgage cost that they're paying. So I think that is the difference we've seen than other periods where there have been very sustained and prolonged periods of high interest rates.
Yes, thank you. And I think that evidence is consistent with other evidence we've had that people will do whatever it takes to meet their mortgage repayments, and that includes putting more pressure on them in other aspects of their life as well. Does it follow then from that evidence that if we were to allow lenders to offer larger loans to more people, that you might expect to see levels of hardship exacerbated?
Well, I think we feel that if the current settings around responsible lending were to be reduced or significantly changed, then our concern is that we would see more cases coming through. So and we can only talk about what we are seeing through our work, Senator, obviously, but we do have 60,000 banking and finance complaints a year. So we do have quite a particular view right across the credit and banking sector. And our concern would be around the responsible lending standards. As we've said, the figures that we're seeing there are largely static. There's been a small increases that we set out in our report, but not significant. And so we believe that that's because those settings are actually working at the moment.
Our data, Senator, as well tells an interesting story for first home buyers. And in particular, as we know, the highest proportion of impaired home loans are in Victoria and New South Wales, as would be expected. But with first home buyers in particular, they are in a unique, vulnerable position with high housing prices, very high optimism, high debt, but also limited equity. And so our data is showcasing particular postcodes in the outer suburbs of both Melbourne and Sydney, where hardship applications and hardship complaints are correlated. So any consideration of how to bring more first home buyers into the market should take into account the pressures already on first home buyers in the current economic conditions.
Thank you. And just, I guess, for sort of the avoidance of doubt or clarity, you don't support obviously relaxing the responsible lending laws, which are slightly separate from this inquiry, but you also don't support loosening the prudential standards or opening up the lending market in a way that could create more risk?
Well, I think we would say really that that's probably a matter more appropriately put to APPA with regard to the buffers and lending standards than AFCA. We did note that the ASIC Commissioner, Kate O'Rourke, was addressing the annual credit conference this morning, and she noted that the value of new housing loans rose 23% in the 12 months to August of this year, with monthly lending reaching 30.4 billion. So she says new monthly lending for property purchases is now larger in Australia than in the United Kingdom, and lending by banks remain the main source at 95.1%. Now, obviously, that's the sort of data that APRA and ASIC would have, and so it may be more appropriate to refer questions about the buffers, I think, to APRA. We wouldn't receive complaints about banks not lending to individual consumers, because that would be a commercial decision of the bank. It wouldn't be a matter for ourselves. So I think we're limited really in our ability to comment on that, Senator.
That is reasonable to comment within your remit. So thank you for your evidence. Thank you, Chair.
Thanks. Senator Pocock, do you have any questions for this witness?
I do, Chair. Thank you. I won't be long. Thank you. And thank you to you witnesses for bringing your evidence forward. I wanted to probe a little on the fact that the rental context really makes a difference to what happens now when someone gets into mortgage stress or default. You've talked about how in previous, tell me if I've understood this correctly, that the normal, when this crisis hits is you may sell your house and you go into a rental accommodation and so on, but that is simply not available to many today. Can you say some more about that and the implications for the homelessness crisis?
Well, certainly where we're seeing consumers in financial hardship and we're working with the bank and them, then certainly what we're hearing is very much that narrative that they're so desperate to maintain the property because they cannot see an alternative route for accommodation. And I think that does mirror what we hear from consumer organisations such as financial counsellors, who you've heard earlier this morning. We engage with them as well as engaging with the banks, as you would expect. And we certainly hear from those networks that is the conversation that's being had as well. I think when we look at the individual circumstances of a case and we look at the repayments due and we look at the private rented market, we can also see that, Senator. So although it may be anecdotal, it is based upon, thousands of cases that we handle each year.
Thank you. And I think I've understood from your submission as well as your evidence that many complaints are in response to lenders not meeting their existing obligations. How can we sort of make sure that lenders are following existing laws that are in place to protect consumers? What would you like to see there?
Yes.
We certainly do have a significant and relatively steady number of responsible lending complaints. They often relate to areas such as failing to make reasonable inquiries to ensure the loan is suitable for the people requesting it, validating that it's affordable, some basic steps at the start of the loan process to make sure that people don't then immediately fall off into a debt spiral after the loan's in place. And so what we hope for is that those requirements and ASIC's associated guidance are complied with. We've actually seen a really concerted effort by a lot of lenders to do that. We've added to that with our responsible lending approach, which was released in December 2023. And actually, we think that the level of complaints is relatively steady because of a lot of good work in that area.
But also our systemic issues function.
That's true. We actually do see quite a significant number of systemic issues, potential systemic issues referred into our systemic issues area. We have been reporting on some of those, and they do sometimes relate to issues such as, I think recently we've had a process failure to make reasonable inquiries about the purpose of the loan, for example.
Okay, thank you. Thank you for that. Can I just ask in closing how your service is funded?
Yes, certainly, Senator. We are fully funded by industry. So we were established by Act of Parliament, and as I said, we're constructed as a company limited by guarantee and a not-for-profit organisation. So our funding comes from financial firms with AFSLs or authorised credit representatives paying a membership fee. There are then fees that the financial firm have to pay, depending on the number of complaints that we have to handle with regard to them. And then there are levies which really target the very heavy users of the scheme. So it's free for consumers and it's fully funded by industry, although we act independently of both.
And do you publish a ranking from good to bad actors in the field of lending?
We publish statistics on all the financial firms that have more than 4 complaints, including all the banks and lenders. And we publish that on an interactive data cube, which is available on the front page of our website. So you can actually drill down and see what financial hardship complaints, what responsible lending complaints we have by individual lender, whether they are substantiated or not, if they are resolved, at what stage are they resolved. So we do that, and we have just yesterday published our annual review, which has got a significant breakdown of our work over the year, which we'll provide to the committee and to each of you senators.
Thank you. You need an awards night, an annual awards night, like the Ernies in New South Wales. Thank you so much. Thanks, Chair.
Thank you.
Thanks very much. Now, I think we're just going to suspend briefly and we'll get our next witness online. I now welcome representatives from the Australian Prudential Regulation Authority. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, please state your full names and capacity in which you appear.
Thank you, Senator. Therese McCarthy-Hockey, Member of APPA.
Sean Carmody, Executive Director at APPA. Chris Gower, Executive Director at APPA.
Marion Corner, General Manager at APPA.
Thank you. APPA, do you have an opening statement?
Thank you, Senator, for the opportunity to appear today. We do have an opening statement which we believe has been provided to you, and we would be incorporated to Hansard, but I would like to take a few moments to mention 3 key points.
Of course.
Firstly, what we're seeing. The system is financially stable with prudentially strong entities operating within it. Our most recent data of August 2024 shows that banks' housing loan commitments are tracking upwards, indicating that credit is flowing and accessible, including to first home buyers. Housing credit growth has increased over the past year and is currently in line with long-term averages. Similarly, first home buyers, in line with the long-term average, have continued to account for around 1 in 5 new housing loans. Secondly, financial system risk in Australia. Household debt is an important consideration for financial system risk in Australia. Australia is one of the highest levels of household debt globally relative to incomes. Over the past 20 years, household debt to income has risen from around 1.5 times income to around 2 times. In percentage terms, APRA-regulated entities have more housing loans on their books than most other comparable countries. Around 2/3 of all loans are for housing in Australia. And finally, APRA is committed to transparency. We have published our macro-prudential framework, which works together with our prudential guidance, through which APRA explicitly endorses banks approving lending outside their default credit policy on an exceptions basis, provided such exceptions are prudently managed. APRA regularly releases reviews of our current macro-prudential settings. We undertake various public speeches, as well as participate in a range of parliamentary inquiries, thereby contributing further to our transparency. And we look forward to talking to you more about that today. With that, we're happy to take your questions.
Thanks very much. I have some questions for you, then we'll go to the Senate colleagues. I guess just starting out with your mandate, does your mandate require you to consider the particular factors facing first home buyers or prospective first home buyers?
Thank you, Senator. Our mandate is about the overall system stability. It doesn't distinguish between any one category of borrower, but we are charged with ensuring that we understand what's happening within the credit within the system. In our financial stability mandate, we balance that, of course, with competition and efficiency and contestability, amongst other.
Okay, so the answer to that is no. What about in relation to the government of the day? The government of the day often sends you a statement of expectation, does it not?
Yes.
Okay. And in this statement of expectations for the current government, when did you receive that?
I don't have the exact date, but it was early in the term. I would say we can take it on notice the exact date, but early 2023.
Yeah.
Actually, I've got the date. Apologies. June 2023.
It doesn't appear to look at ask you to look at first home ownership as a virtue either, does it?
We are not mandated to look at any one borrower class. There's often interest to understand various lending to different segments. First home buyers is obviously subject of today. We often asked about small lending to small businesses, lending for infrastructure. Importantly, what we do is we set a framework which enables a sort of neutral understanding of the risk in the system, and that's what, in particular, our credit rate system provides, an ability to understand the risk in the system. I would say one thing that's interesting about our statement of expectations, it talks about to facilitate the flow of finance to support strong, sustainable economic growth.
Yeah.
And that's something we do see, that a strong and stable financial system does, in fact, enable that strong, sustainable provision of finance. We see the data, which I've already talked about. It enables people to go about their lives, get access to finance where it's appropriate. So, and also for businesses to do their business.
Sure, but it doesn't, the point is it doesn't ask you to do anything on first home ownership, and nor does your mandate, which is not your problem. I'm just trying to get to the bottom of where exactly we start here. But then it does go, the statement of expectations does ask you to look at the expenditure matters of the superannuation industry and various other things to do with superannuation. So the government can be quite particular if it wants to be, can't it?
But what our statement of expectations is a matter for government. That's correct, Senator.
Yeah. Okay. How much capital are the banks currently holding against mortgages?
Well, they hold a capital on a proportionate basis. We've seen capital levels. Our requirement is that they would be unquestionably strong, and they hold capital across their whole book. And those levels are well above the minimums as we require them.
So you said that through your prudential standard?
Yes. So we set expectations for how banks would measure and calculate their risk, and then the capital that they would hold against that.
Which prudential standard? Is it capital adequacy or another one?
I might turn to our head of policy.
So the
capital risk management, is it?
So the relevant standards for there's a range of different standards that specify the so-called risk weighting of different types of exposures, and the two relevant ones are known as APS 112 and APS 113 that specify for credit risk what the capital requirements are for all the different classes of lending.
So what are those two prudential standards called?
So the one is about the standardised approach to credit risk capital, and the other is about the internal ratings-based approach to capital. So
they're called?
I'll get the wording slightly wrong if I say it, so maybe we can give you the exact ones on those.
Well, I can just Google it if you don't know. I mean, it's not going to be that hard. What are they? Sorry, you don't know what the prudential standards are called.
So it's APS 112 and APS 113, which is the ADI Prudential Standard 112 and 113.
Okay. But what are the name of the documents? Are they capital risk management or are they capital adequacy? What are they called?
I can Google it on the spot for you to get the exact name, but as I say, one of them is relating to what's called the standardised approach to credit capital, and the other is the internal ratings-based approach. So 112 is capital adequacy, standardised approach to credit risk.
Okay. So one's called capital adequacy. What's the second one?
And the other one would be the internal ratings-based approach. So essentially the same thing, but is the internal ratings-based rather than the standardised approach.
Okay. And in these standards, you set how much risk capital the bank should set aside for mortgages, don't you?
That's right. So essentially it comes up with what we refer to as risk weights, where for a given dollar of exposure, that'll be weighted by a risk weighting factor that is basically a measuring tool that looks at the relative risk of different risks. So, for example, mortgage lending, being a type of secured lending, is relatively low risk compared to credit cards, which attract higher risk weights, as an example.
Okay. And then do you apply different risk models to different types of mortgages?
There is, within the standardised approach, there was, I think you've heard in some of the previous hearings that there were revisions made to the capital frameworks a couple of years ago. That was with a view to making increasing the risk sensitivity of these things. So it does differentiate a bit more on different risk factors, and the two key drivers are in the risk weights for owner-occupied, sort of standard owner-occupied prime principal and interest mortgages have a lower set of risk weights than for interest-only and investor loans. And the other key dimension is there's bands by loan-to-value ratio. So low loan-to-value ratios have lower risk weights and high loan-to-value ratios have higher risk weights. And lastly, there's a differentiation for those higher loan-to-value ratios, those above 80%. They also are differentiated based on whether there's lender's mortgage insurance in place or not. So that's within the standardised framework. The internal ratings-based approach, which applies to a smaller number of the larger banks that have more modelling capability, those factors are supplemented by their own credit risk modelling, but they're subject to a floor that references the standardised approach. They might have more granular differentiation of risk than those standardised approaches. So they're the key.
So there's a wide range of approaches, isn't there?
So, Senator, I might just before we get into more detail, just step back just a moment, which is just to talk about, well, what is the framework trying to do? And the key point that Sean was talking about there was the measure of risk. So if you think of a ruler,
I understand that.
This is about the measure of risk. It is not an incentive tool, and it does have gradations within it, which you're hearing about, and that's because the core aspect being considered has a different risk performance.
Yeah,
so that ability to understand the neutral setting and such that that we can ensure that the right amount of capital is held against that, and organisations can make their commercial decisions accordingly as to which sort of sector they will play.
I understand that. Sorry, we don't have a whole lot of time, so trying to keep answers as brief as we can, so we can share the call. So basically, there are a range of different approaches which you have deployed. So you've taken the view that investment loans should carry a higher risk weighting than non-investment loans. Is that right?
That's correct. In the framework, that's one of the differentiating factors. Correct.
Okay. And so then what generally do banks do? Do banks then, if they hold a higher amount of capital against a mortgage, then what pricing impact does that have in the market?
Well, practices will vary across banks, of course, but obviously, ultimately, the amount of capital that they hold, given that they need to generate a target return of capital, at some level of return on their capital for shareholders, will be one of a number of factors that go into the pricing of their products. There'll be operational costs, a whole range of other things, but absolutely, in all else being equal, you'd expect that loans subject to higher risk weights, given that they're more risky, will also, on average, attract higher margins, which ultimately is a price signal of risk, essentially.
So if there's a lower capital risk weighting, you'd imagine the mortgage would be cheaper?
All else being equal.
Yes?
Yep.
Okay. So then how much capital is currently being held against mortgages across the banking system? Do you have that number there?
You mean in dollar terms?
Dollar terms, yeah.
I don't think we've got that particular number.
Take it on notice?
We can certainly take that one on notice.
And could you also take it on notice how much capital is being held against first home loan mortgages? Do you have that distinction in your data set?
We don't have it cut in that direction. I suspect we don't have it cut in that way, but I can certainly confirm that.
You don't know how many first home mortgages there are?
We do have data on numbers and volumes. We don't necessarily have the attribution down to the average risk weights associated with them, because to be able to do that, you need to break it down into all those different risk characteristics I mentioned before.
But wouldn't the banks provide that as part of their reporting obligations?
Well, that's something we'll have to confirm. But as I say, off the top of my head, I suspect we don't have that attribution on the capital basis as opposed to the dollar flow.
Okay, so when you deploy your macroprudential tools like a serviceability buffer, do you give consideration to first home buyers specifically?
So thank you, Senator. So our macroprudential tool set has a range of factors within it, serviceability buffer being just one. It's important to recognise that actually there are different measures that we're using that work in concert with each other, and the purpose being the overall resilience of the system against shocks in plausible and plausible risk scenarios. It is a broad tool, and it doesn't relate to any one category. And that goes to our other feature of our framework, and which we give explicit guidance around exceptions. So that example of first home buyer, the right type of first home buyer with a profile which would support an exception, that's something that can be explored. But it's not any one category that's carved out. Just as you heard earlier as well around the risk weights, Actually, the risk weights around and the risk performance of first home buyers and owner-occupiers across the system is very similar, so they would deserve the same amount of resilience, protection.
So are there any buffers in the current risk weighting models, do you think?
Buffers in what sense?
Well, I mean, the banks are holding above and beyond their regulatory capital obligations. Do they have any room there, or are they on exactly where you want them to be?
So look, I think it's fair to say that we think that there's an adequate amount of capital in the system today. There are regulatory minima, and routinely, as in all jurisdictions, banks will maintain a certain degree of buffer to absorb volatility of swings up and down. But overall, we think that the capital in the system, the system's well capitalised, and that's what makes us a strong financial system.
Okay, so the last question I have before I bring out the call is just in relation to the point you just made about it being a broad tool. So clearly, because it is a broad tool, it applies to things like fixed mortgages, fixed rate mortgages, where there is no potential for there to be an increase over the period of time of the loan. So therefore, having a buffer in place makes no sense.
Thank you, Senator. So I think you might be alluding to interest rate piece that is one part of the consideration, and it's certainly not the aim of the tool. The tool is aimed at a much broader sense of unforeseen circumstances across a range of factors on income factors, expense factors. It looks at credit and leverage. It looks at asset prices, lending standards. It has a variety of aspects that we consider when we are setting the serviceability buffer. I think probably a point of note that just for the Australian system, just worthwhile clarifying, that when we talk about any sort of features of fixing, that's actually often quite short. That might be in a 1 to 3 year period, maybe the longest being circa 5 years. So that's actually quite short in terms of
the average mortgage only 7 years now, isn't it?
Of the mortgage and the obligations. But just to be clear, that the serviceability buffer is about a much broader set of considerations. And right now, we are seeing things like non-performing loans ticking up. That's at about a 1% level. Now, that's nearly double what it was in 2016. Are we alarmed? No, we are not, because we think it's still manageable. But we're in an environment where employment is still very strong. And so if employment were to change, we do see that would be a different set of outcomes for borrowers. And that's the kind of resilience we are looking at. So it really is about looking at the circumstances in front of us, looking at the data and looking at the uncertainty in the environment, not a prediction tool of any one part or another, but rather how we see the overall settings of the system.
But, I mean, as you say, it's a broad tool. You don't take into account the particular factors facing first home buyers. It is a broad tool, isn't it?
It is a broad tool, and we take into account factors that we see for the whole system. And you talked about their one particular borrower class. We have given banks, and we expect banks to use where they see it prudent, exceptions for the first home buyers who might warrant a different treatment. I think it's important to note that not all first home buyers are alike. In fact, they have each borrower, and that's what it shows, whether it be owner-occupier borrower more broadly or investment borrower, investor borrower. Borrowers have discrete features, and we're talking about here the overall system stability, the provision of credit, which is holding up, and that banks who know the customers best are able to make those judgments. And that flexibility is available and is being used. I think it is important just on that sense of what is the use of exceptions. We have seen the exceptions use rise from around sort of 2% area to nearly 5%. Okay. So we can see that banks are taking exceptions, making exceptions, which we expect and support them to do for the right kind of borrower, such that they are in the position to be able to maintain and their obligation.
Well, of course, I expected you to come to this committee and tell us what a great job you're doing, of course, so you haven't disappointed there. Deputy Chair.
Thanks very much, Chair, and thank you for being here for this latest inquiry into housing for the Senate Economics Committee. I think one of the things that has come out of the evidence today is that there has been overwhelming support for the role of APPA in being the right body to independently set and maintain our prudential framework. And certainly even people who are questioning the levels of the serviceability buffer, which has been a big focus for today, have, in what I've heard, again indicated overwhelming support that it should be APRA, the independent regulator, that sets and maintains the framework. I guess people, may have questions about how you go about doing that, and you've started to answer some of those questions from the chair towards the end of your evidence there. You've gone to some of the factors that you do take into account in reviewing and setting the buffer. I wonder if I could just, straight out ask you to tell us why the buffer is at 3% today, and why not review it, given that we appear to be at the top of this tightening cycle.
Thank you, Senator. So I think the very first important thing to note is that it's not about interest rate cycle in that way. So as I laid out before, it's really about a range of factors, unforeseen circumstances across income factors, expense factors, much broader. And we certainly aren't trying to predict where over a full life of a loan where rates may go. That's certainly not what we're doing. We're looking to make sure we've got a resilience. I think I will head to my colleague Marion Kohler, whose department does a lot of this detailed work. In looking at those range of factors, though, we do consider the data and what it's telling us. So when we look at where we are right now, we say, well, what's the case for change as well? So what's the uncertainties that we're seeing? What's the performance of what is the availability of credit to the system? Is that holding up? Is that what we expect it to be? Is there anything alarming? And we see that it's as robust. And then also, are we getting the right intended outcomes around that? Maybe Marion, you'd like to just talk a little bit more about the process?
I can make three short remarks to the macroprudential frameworks that hopefully speak to what you were looking for. So first of all, I want to reiterate, there's a range of tools. The serviceability buffer is just one. These tools work together and we calibrate them together to mitigate the vulnerabilities and risks at that system level. So you can't pull apart just one and say, we'll put that aside. The second point is it's not set and forget. We do a review whether the calibration is appropriate regularly, several times a year, whether it's work as intended at the system level. We also review whether there are unintended consequences to that. The way we go about the review is we're looking at a broad range of data. We're looking at how credit is tracking. We're looking at leverage, the level of debt. We're looking at asset prices, at lending conditions, and also at indicators of financial resilience. So this is a broad raft of indicators. Interest rates is only one small part of the whole picture. And finally, we consult with the CFR or CFR colleagues when we do that, ahead of us reviewing our internal settings as well. It's always good to have other people looking over that and bringing their opinions in there. So the third point I want to make is what we're seeing, and we've heard some of that already. Credit is flowing at about average rates, and that includes to first home buyers. And there are areas we're watching carefully right now where we're not concerned, but there is always areas that we need to look out for, being forward-looking, to look at vulnerabilities and risks. Credit growth has been picking up over the last year. It is now going at about average rates, and so house prices. We've seen arrears and non-performing loans tick up a little bit. We're not concerned, but as was mentioned earlier, The labour market is expected to ease a little bit further, so this is certainly an area we're watching carefully. And the last point I would want to make, we have at a starting point already quite high household debt to income historically and across countries, and there's just a baseline of a vulnerability in the system that we do need to do.
I've got a few more questions, and I understand that the answers that you want to give are really detailed, but I know that the chair is also going to want to share the call in a moment, and I just wanted to ask you for a comment on how you think the buffer has served its purpose in the current cycle that we're in, notwithstanding that I have understood your evidence that it is not only about interest rates.
Thank you. Yeah, thank you. Look, other comments, and I might start with an overall couple of comments. If we look at the period we've come through, there's been all manner of very like shocks to the system. The COVID environment, the withstanding overseas bank defaults in early 2023. So just ongoing uncertainty in the system. And it's shown that borrowers have been able to be, in the main, staying in their homes and able to stay up to date on their mortgages, the mortgage repayments. We have seen good performance of the books. We've been watching that very closely. I mean, there was some sense that we were very concerned that some of the, if you remember the mortgage cliff environment that we were talking about, there's a lot of discussion about what's the system going to be resilient enough to be able to withstand that adjustment for borrowers. We did see that actually happened. And so we have, I think colleagues already talked about, sort of, are we getting the intended outcomes? We do look at those as successes for the system, that we've been able to move through that in a smooth way, and that we have played our role as part of that, and that ongoing ability for business to continue and borrowing to continue at the household level as well. And so we do watch that data. It does move around a little bit quarter to quarter. We are watching it very closely, but long-term levels, they're holding up, and it is very orderly.
There's been some discussion on this inquiry, I think, because witnesses have been asked to think about these issues. There's been some discussion on this inquiry around, I guess, broadly setting different prudential standards for first home buyers. And I wondered if you could comment on that as a concept, and whether such an approach would enhance the stability of the financial system or have a different impact.
Well, we are always thinking about our tools, what's working, what are learnings. I think in this particular question, is there any one borrower class that we would sort of just carve out? And our discussions with banks and the evidence we see is that not all, in this case, first home buyers are alike. They have different features of their own circumstance and ability to pay, their outlook. So those are really matters for the banks that lend to them, and we've got that flexibility. I think more broadly, thinking about first home buyers, they have a range of features that do require looking at them individually. Again, they generally might have a higher loan to value. They might have a lower deposit. That's typical. But they often have different projections in terms of their income and so on. So just that individual circumstance, to carve out one class of borrower from another, we wouldn't see it that way.
And you wouldn't want to see us but you wouldn't want to see us recommending that at a macro-prudential level that there be different settings for different classes of borrowers. It's a matter for the banks to use your settings and apply them to their database and their knowledge that they're required to have of their customers.
Yeah, and you come to a very good point. So we see our role as the independent regulator to provide that real clarity on what risk is in the system. Our framework, I've talked about already, and Sean Carmody did as well, talked about it is a measure of risk. So by doing that and providing that understanding of the risk that we see in the system, and the capital to be held against that it's a strong understanding of the risk in the system, and that banks make their commercial decisions as they see fit, but government also can make their decisions as to where they would like to change the risk profile of a borrower. And that comes to, say, the first home buyout program that are currently in place, where the guarantee or change of their deposit capacity means that the borrower, that loan changes its profile. It is a lower risk borrowing. Our framework actually adjusts for that. So we don't incentivise it from our perspective. Our job is to actually make sure there's a neutral and common understanding of what that risk in the system is, but it is responsive. It will respond to where government would, in certain circumstances, should they see fit, make proposals or schemes accordingly. And again, the first home buyer schemes that are currently available are given a more favourable treatment in our capital framework, whichever you think is appropriate.
Okay. Thanks very much.
Just finally,
last question,
just one.
We get some shorter answers might be helpful as well.
Sorry. Thank you, Senator.
I'll put my question. I mean, it's obviously, more than tempting in the current environment where, it takes several times the average income to buy a house where housing affordability is a real problem. It's obviously very tempting for, many of us in the parliament, many commentators to want to push the serviceability buffer down, really just for the purpose of allowing people to borrow more at a time of high house prices. But from your perspective, what are the risks of doing that when you're looking at, the stability of the financial system as a whole, and, perhaps particularly given the high number of the high proportion of mortgages on banks' books, I guess, in Australia as well?
Yeah. I think, Senator, just to draw out what you've said there, affordability of housing is no doubt a challenge. We see that. And that goes to supply factors, price factors, and so on. But we want to draw a clear distinction between housing affordability and access to finance. APPA's role is around access to finance. Our prudential tools are focused on the finance accessibility. There are many factors affecting affordability, but that's different. So you're right that we would see that our tools focus on access to finance. They're not tools shaped to solving an affordability challenge, which has got a vast number of factors, as we've heard about, in particular on the supply side. Banks talk to us about that they see that as a challenge there. And it's important to draw that distinction because our tools are not geared to solving an affordability challenge, but rather the provision of finance. And as the data said, it's holding up, and including for first home buyers.
Thank you. Senator Pocock.
Thank you, Chair, and thank you all for being here. I agree with Senator Walsh's summation of the evidence we've heard that there's certainly support for the current settings of the buffer, and Westpac, for example, described them, as you no doubt heard, as appropriate, and many others have. But there is another question out there about whether APPA is the right spot to be doing this, and I just wanted your comment on that. Some have suggested, for example, that Parliament might have a role in relation to prudential settings. What hazards would you see with a shift of that kind? I'm not advocating it. I'd just like to hear your views about it.
Senator, thank you. We see our role, we take our role very seriously. We currently have that mandate. If that mandate were to change, that is a matter for Parliament to decide that. But we would like to demonstrate that we take it very seriously. We do it to the very best of our ability. We've got a lot of experts here, and we think that the data around, in this case, access to finance and the orderly function of the system, the stability of the system, is something that we can hold our ourselves to, and we can see the evidence that's performing well.
Okay, can I ask you then on another front? We heard evidence this morning about the US system for some first home buyers of greater access to long-term fixed interest loans. I know you've just said clearly you're not about managing affordability, you're about access to finance, but have you given any thought to an approach like this in the US which would increase access and predictability for many people undertaking large loans? What might the risk implications might be of an approach to housing finance like that?
Yeah, thank you, Senator. I'm going to pass to my colleague. I'm just sort of start to say you're very aware of what's happening in different systems, different structural aspects around the globe, and we're very focused on actually what's right for Australia. But in any case, my colleague can add to that.
Thank you, Tracy. Look, I'd just start by saying, we don't sort of mandate or sort of impose any particular product features for the banks, but I'll sort of make a few sort of general observations looking at different markets. I mean, the US, as you noted, a very common product in the US market is sort of 30-year fixed rate mortgages, and in fact, they're not just fixed rate. A very common thing is that you can refinance. If interest rates go down, you can refinance with no penalty, and if interest rates go up, you can just keep that rate. So that, that's obviously very attractive to many borrowers. The flip side to that is that, that is quite unique to the US. You really don't see that in other markets, and a big part of that is what the options are to US banks to manage the associated interest rate risk, because if their borrowings are moving around at the cash rate or other interest rates move up and down, but their assets in the form of their loan books aren't, they need to manage that interest rate risk. And there are tools available to the US banks in terms of a much longer dated treasuries market than exists here in Australia. And there's a whole range of factors. There's a very deep, well-established interest rate options market that's widely used for hedging. It's probably also worth noting that a significant volume of mortgages end up not being financed through the banking system, but through schemes like Fannie Mae and Freddie Mac. So it's really quite a different market. I think, in my view, there'd be probably some challenges for Australian banks to establish scale in very long-dated products like that without incurring significant interest rate risks that then would need them to capitalise for. So it may end up being a costly exercise.
Thank you for that. I wanted to go to some other tools that you have used in the past. What were the effects of the 2014 and 2017 restrictions on investor lending on house price growth and the share of new lending going to investors versus owner-occupiers?
Thank you, Senator. So those tools, just to set this up, just to give you a bit of context. So the context is that we would obviously take action where we see emerging risk or risk of financial system stability. Again, I had said earlier, but we don't incentivise any one part or the other in terms of the proportion within the system. We're looking for the orderly and safe system. But we will take action where we see risk. And so in that regard, we took action at that time.
Yes, so as my colleague outlined, under the macroprudential framework, we look at a range of indicators of risk, and that includes credit growth. And we've heard that credit growth is increasing, and that's broadly equivalent across owner-occupiers and investors at the moment. The measures taken previously were at times where we saw speculative investor lending, which was having an impact on house prices at the time. And so from a risk-based perspective, it was appropriate to take that action at that time, and that did have the desired impact in terms of investor lending. At the moment, as we say, we see a fairly healthy outlook in terms of credit growth, but it's something we continue to look at because as we said, there are a range of tools that we can turn to, including those kind of.
But thank you. That's helpful. But I'm actually trying to get at what impact those particular measures had on house prices and on the share of lending to owner-occupiers versus investors. Are you able to answer that, or would you like to take it on notice?
We can take that on notice for the exact numbers, yeah.
I mean, the one thing I will note is that certainly once those measures came in place, the share of investor lending relative to owner-occupied did drop, which, as my colleague said, that was exactly the intended effect, but we can take on notice the flow through to house prices at the time.
Thank you very much. According to a recent article in the Financial Review, housing investor borrowing is at its highest level now over the past for more than 2 years. Do you think this is contributing to a significant price of housing growth or increases? And would rebalancing the share of residential mortgage lending in favour of owner-occupiers as a broad class, such as by further restrictions on interest-only loans or targets limiting loans to investors to a proportion of new lending, have any adverse impact on financial stability?
Well, thank you, Senator. We look at data on a much longer perspective. So even if you've got some data there around a couple of years, we're looking at a much longer trend, and it's not actually changing that much. So the sort of 2/3, 1/3, it's about where we've seen it sort of moves around, as we say, even quarter to quarter, year to year, but broadly 1/3 being owner-occupier, 1/3 being investor, 2/3 being owner-occupier. That's not terribly different, and so that we don't see it as exacerbated at the moment. I think my colleague Chris Gowan's already mentioned that we're not seeing any heightened poor lending practices in any one part or the other. So it is that we are seeing good lending standards, good ongoing growth in all parts, notwithstanding some movement around from one category to another. We're not targeting that. We're targeting overall system stability, and we are seeing that it's entirely reasonable at the moment.
I might just add one other note there, which is I believe that figure that you're quoting, Senator, is it's at a high in dollar terms, and given that overall growth has been growing at an average of about 5% or so every year, the dollar values just do, on average, get higher and higher over time. And then the other thing, on interest only, what we've seen is we haven't really seen a return at the same level of interest only as we'd seen previous to our other measures, and that's partly because if you're an investor, you can't really choose to take out an owner-occupied loan instead if you already own your property. But if you're a borrower who's looking at interest only and you think, I don't like the price, it looks too expensive, you've always got the option to substitute into principal interest. So we haven't seen as much of a bounce back of interest only as relative to our previous intervention.
Thank you. Last question. You've made the point that Australian banks are very exposed to residential mortgages relative to comparable countries. And I just wanted to ask what your thinking is and what you see in relation to bank profits in Australia. What proportion of bank profits in Australia come from residential mortgage as opposed to other types of lending? Can you give us some insight into that kind of side of margins?
Yeah, so I think the overall premise of profitable banking is a positive one in terms of a stable system. That's important to acknowledge. And in that regard, banks which are profitable are generating income or returns such that they can reinvest that back into lending. And then that's an important feature. And we see systems where that's not the case. Actually, it's very value destructive to the economy. So I think just understanding that bank profitability is a positive thing. In terms of the actual profitability of features of how we're seeing the competitive landscape and the bank's returns, one is that we are seeing them compete very hard in the mortgage space. So we see that mortgage brokers are actually a bigger feature of the system than ever before. And there are cashbacks and all manner of incentives to actually win business. So we can see that competing on price is quite a feature of the market today. That has had an effect, actually. Return on equity is certainly, it's robust, but it's certainly not elevated as it was, say, pre-GFC times. It was really much lower than that. And NIM compression, that's net interest margin. So there's sort of the difference between where they borrow and where they lend, that is compressing or tighter. So that means that banks are actually using more of their margin to return to compete, to win business. So ultimately, we are seeing that banks are really working very hard to actually maintain their position
and their volumes, and they do this on a profitable basis, which we think is a positive.
That's a very strong defence of bank profit. We do know that our banks are extraordinarily profitable in comparison with others in other countries. In a housing crisis of the kind that no one is arguing about is very real, the biggest in the post-war period, with many of the most disadvantaged, most affected. What is your view about banks giving a bit of that profit back in the form of, for example, taking the cost of mortgage insurance into their balance sheet rather than leaving it out there, forcing families to think about groceries versus their mortgage?
Last question.
Yeah. Thank you. So we don't have a view on actually how banks should do their business, which parts that they should compete away. We do see them competing very hard. I think on a comparative basis, we do have a good and strong banking system, but I wouldn't call it extraordinary compared to many others. Other systems also have good and strong banks. But
probably the only thing I'd add, and I think one of the earlier witnesses made a similar comment, is it's certainly something that banks can do, is make decisions to say, well, not to use lenders' mortgage insurance for a particular loan. However, what that does mean is that the risk associated with that mortgage sits on their own balance sheet rather than on the insurers. And that's why, as I mentioned earlier on, our risk weights are higher for high loan-to-value ratio mortgages that do not have lenders' mortgage insurance. So getting back to those other things, all things being equal, banks that didn't require lenders' mortgage insurance on a loan would most likely, on average, charge a higher price for that mortgage because they are holding that risk. So it may end up being swings and roundabouts if that was done.
Okay. Thank you very much.
Thanks, Chair, and thanks for your answers.
Thanks. Before you go, and I know that you've given very long answers today, so I just have two quick questions for you. Maybe you can give me some shorter answers. In terms of the risk difference between owner-occupied and investor loans, what is the difference in capital that you're requiring be held against those two classes of loans?
Well, as I noted before, there's essentially a table of risk weights for each of those, and it does vary by loan-to-value ratio. It also varies based on whether there is or is not lenders' mortgage insurance in place for those higher ones. I mean, we can certainly on notice provide you with the table. It's in, as I mentioned, it's in the capital adequacy standard APS 112 that I mentioned earlier, but we can certainly point that out specifically.
I think it would be useful to see the different permutations. Is there a particular risk difference between those two types of loans that you are concerned about?
So, I mean, the idea of all of our risk weights is to be sort of founded in risk. I mean, as we said at the outset.
What is that risk difference?
It's basically whether on average long term is there a higher risk of losses, which ultimately poses a risk to depositors.
How big is that difference?
So in terms of risk weights, that's the table I can.
In terms of delinquency.
Well, the thing about the capital framework is it's not supposed to be an estimate of the current point in time delinquencies. It's about providing resilience under sort of plausible stress scenarios. So really, a lot of these things are calibrated looking at in downturns. Yeah. And there's been a lot of evidence when there has been sort of significant downturns in housing all around the world that losses on investor loans have historically shown to be higher, and since that's something that's very a common feature of mortgage markets around the world.
Okay, but it's a very easy thing to change based on various judgments, given it sounds like you have lots of different permutations. So finally, I just want to ask you about the Murray Financial System Inquiry. So that recommended that mortgage risk weights lift from 15 to 25%, did it not?
Yep. So,
yes, no?
Yep, that's correct. So there was a focus on mortgage risk weights there. There's actually, in addressing that was often referred to as, ensuring that banks, Australian banks are unquestionably strong. I think you heard some of the other evidence that it allows access to international capital markets. But we've now got a framework that was comprehensively revised. It's sort of influenced by the international so-called Basel capital frameworks as well, which were informed by a lot of the learnings from the global financial crisis. And I think it's fair to say that we've got significantly stronger capitalisation in the Australian banking system today than at the time of that financial system inquiry, which I think underpins the strength of our system.
So we're about 25% now, are we?
It varies across bank by bank, but we can certainly give you the information in those prudential standards. We'll pull that out.
Can you give me that as an overall, and also as what percentage first home loans would be as a proportion?
I can certainly give it to you overall. As I said in an earlier answer, we'll have to look to see whether we've got that specific calculation for capital attributed first home buyers. If we do, we can certainly provide it.
Yeah, because I mean, there hadn't been any bank collapses under the 15% model, had there?
Have there been major bank collapses since 2014? No. I mean, there's obviously been...
Before that, when it was a 15% model.
Well, that 15% was not... I mean, that was really the averages of certain banks. That wasn't the overall system.
Okay. All right. Look, thanks for your time today. We do appreciate it. You now go with our best wishes, and we'll move to our next representative, which is representatives from the Proptech Association of Australia and Co-operative. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. And once you take your seats in Canberra, I'll ask you to please state your full name and capacity in which you appear today.
Kylie Davis, as the President of the Proptech Association of Australia. All good?
Okay, and do we have Co-operative? We do? Go ahead.
Hi, attending virtually. Linda Coker, CEO and co-founder of Co-operative.
Okay, do you have brief opening statements?
We do.
Yep. And
okay, we'll go to the Proptech Association first for a brief statement, then we'll go to you, Co-operative.
Sure.
Thank you.
Thank you. I'm very grateful to be here on behalf of the PropTech sector, which represents approximately 480 technology businesses that serve the planning, design, construction, property and real estate industries. And the work that my members do can be explained quite simply, that we look for pain points in the existing way that property is planned, built, paid for, bought, sold and managed, and we identify ways that technology can alleviate and solve those problems. The reason our sector is growing so rapidly is that, as you all know, there's a lot of pain in the property sector and in the processes with how we buy, plan, build and own property. And at the core of this is one really key theme, I think, that within the housing supply chain we have sectors with deeply analogue systems that and business models that are feeling the pain of resisting what is now a digital world. And two examples of this: responsibility for planning of Australia's housing system is deeply fragmented across 512 councils, 8 state governments and a federal government. So right there, you have at least 520 different approaches to modernisation and digitisation of planning processes. The second is the construction industry, where our approach to building homes in Australia is pretty much unchanged since the 1880s. Blokes with hammers, concretes and bricks turn up to a site and they seek to construct new homes. As a technologist, this is frustrating because we can see the solutions are out there. The data tells us that land availability, zoning and insights into new property coming to market, it does exist, it is out there, it is simply sitting in PDF documentation inside our councils and inside state and territory governments. It is an analogue data set and therefore invisible and opaque, and it desperately needs to become digitised, and it could be quite simply. We also have 20 years of transformation across manufacturing and logistics industries that literally hit a brick wall when it comes to construction. Less than 5% of our homes in Australia are prefabricated, compared to about 80% in Europe. And a prefab home can be built in 12 weeks compared to 12 months for a traditional build. So to address the underlying core issues that constraining housing supply, we need policies that support the productivity and efficiency of the planning and construction industries, some harmonisation around legislation and some common standards and vision, and more support of the adoption of innovation. And we look forward to giving evidence here today.
Okay. Property.
Thanks. Good afternoon, and thank you for the opportunity to present here today also. At Co-opity, we're addressing housing affordability by enabling Australians to co-buy property on title with friends or family. Recent YouGov research earlier this year shows that circa 47% of Australians across demographics would consider co-buying with a friend or non-romantic partner due to affordability concerns. Many don't put the necessary legal protections in place, and what our platform does is provide a simple digital experience to co-buy along with the execution of a co-ownership agreement, which defines the rights and obligations of all co-owners. We believe co-owning with family or friends can help first home buyers onto the property ladder faster and more cost effectively than some other affordability solutions, as it involves less debt, less fees, and accelerates ownership for more people in unlocking supply, especially in the inner and middle rings of our cities. It also provides a flexible option for existing homeowners, particularly retirees, to gradually sell down their property investment, optimising their capital gains while improving their cash position and encouraging wealth transfer across generations. Over the last decade, the Bank of Mum and Dad has grown by circa 2,000%, according to Digital Finance Analytics. Co-opity believes parents could co-own on title rather than give money to protect their financial security and retirement. Co-buying enables asset protection and is better than a loan, as banks often view this as a debt of the child, hindering their affordability, meaning children can borrow less, bringing forward the transaction. Parents can also use their fraction as security rather than putting the family home at risk. Co-opity were only launched in April of this year, so we're building out a network of trusted partners, mortgage brokers, wealth advisors, accountants, property firms to help them unlock the co-ownership opportunity for their clients. We are in discussions with lenders to try to deliver an integrated co-ownership and lending solution that works for many natural life and family scenarios. For example, parents helping their kids buy, deceased estates with multiple children inheriting, divorce, granny flats, which can be fractionalised because they're not on separate title, and later in life co-buying. However, lending policies remain restrictive, and we believe they fail to recognise that the credit risk is lower when people co-buy as a cohort, as stamp duty, mortgage repayments and ongoing costs are shared, albeit liquidity risk is higher currently as there's not an established secondary market for percentage shares of residential property. I'll hand over to my co-founder Liz Roche to talk briefly to some of our views on current credit tax settings.
Questions now, given the time we have. So I think we're missing a couple of people who didn't sign in at the start. So did we get Ms. Roche?
Roche, yes, I'm here.
State your name and capacity in which you appear.
Yes, Liz Roche. I'm the co-founder of Co-opity.
Yeah, and Mr. Austin?
Yes, good afternoon. Frank Austin, Head of Distribution at Co-opity.
Yeah, thanks very much. Okay. Now, I guess I have a couple of questions to Proptech. So what are you asking, what would you like APPA to do?
We would like APPA to... Look, we see that there is a lot more data coming through the open banking system that we understand that allows the actual risk of individuals to be seen as opposed to applying these broad kind of modelled risks. So what we can see is that young people today, basically the burdens that the hurdles that they're having to jump through, this model of an 80%, well, a 20% deposit to an 80% to 80% loan is extraordinarily old, and why do we do it that way? Because we've always done it that way. But we now have the data around spending, we now have the data around how people are saving, we now have the data around how individuals are performing and how they're able to pay down home loans, which we see could potentially create more opportunity to understand that risk at an individual level better.
So I'm just not clear what exactly you're wanting to change. Are you wanting something differently, or what are you wanting to happen here?
I think there's a bigger conversation to be had around.
Okay.
Sorry, I can't go into any more detail around it than what we've put into our submission.
No, that's okay. That's much appreciated. And so I guess to co-opity, I guess my main question is, what is it in the banking code that you think needs to change?
I'll give this.
Yeah, so under the Banking Code of Practice today, there is this requirement that to actually borrow in a co-owning scenario, you need to actually own 30% or more of the property. Now, Bank of Mum and Dad is a classic example where that 30% threshold is rarely met. We're talking around a 10 to 20% purchase generally by mum and dad, co-buying with the kids, which actually means in terms of income support, the parents actually cannot give that income support either. Serviceability is assessed against the children who have the majority of the ownership of the property and therefore are the ones actually borrowing. Whereas in the conversations we've had with our potential customers and our customers, mum and dad want to not only buy into the property, but they want to be considered where they're still working as a borrower for that property as well, to give that income support. They want to take on some of that mortgage.
Okay, I might just get you to take on notice the detailed changes that you're seeking exactly to the banking code, just so we can proceed with that line of inquiry for you. Okay, thank you very much. Senator Pocock, do you have some questions?
Yes, I do. Thank you. And thanks all for being here and for your very interesting submissions. Can I just go to a comment in your Protex submission where you said, quote, making it possible for first home buyers to lend more only deepens the issue. I assume you mean makes it more difficult. Why do you think some, a minority it must be said, have been pushing for more debt capability to be taken on by first home buyers?
When you say some, do you mean some banks?
Some of the evidence we've heard, there's certainly people out there proponents for making it easier to get more money, to borrow more money by having lower prudential requirements. And why do you think that's being pushed?
I think it's the system that we know, and I think it's what makes the whole system go around, right? But what we're trying to solve here is for housing affordability. Housing affordability can only be fixed by housing supply. Housing supply can only be fixed if we actually address the core fundamental issues of inefficiency and lack of productivity in some parts of that process, and then pricing will come down, which will allow more people to be able to afford property at the levels that we've got. But at the moment, the only way to afford a property is to stretch yourself as far as you can, or work out how the rules can be stretched to make sure that you can get onto that ladder.
And your argument is that we are acting like analogue users in a totally digital world in every aspect of our housing system, not only in financial but also in construction and the way we regulate and respond to regulations. What is the most important thing you would like to see change that would assist dealing with the crisis we're in?
I think one of the biggest black spots that we have at the moment is around property coming into the system. We know that we need to be producing 200,000 properties a year, 150,000 properties a year. We're rarely doing that. And the part of our system that is planning and, LEPs, environmental plans, we know from the council system what's in train, but we have no visibility of it. And so then we don't have the ability to really test that data and to pull it in real time to start to see what's coming on, when, and what might be holding things back. So if we can And the reason we can't do that is because councils are asking the submission of plans and to be submitted by PDF, and they are not machine readable. So just one simple tick the box on the Adobe PDF to make sure that the planning can be machine readable would allow us to then capture that data at an extraordinary level, which would then start to give visibility of what is already planned, what is already in system, and when it is likely to start to come through the system. And that would revolutionise how we plan and forecast and understand the housing, what's available, what levers are available to push on that. At the moment, we simply model based on best past practice, and we hope that that's right. And what I've heard today across the inquiry seems to be a whole lot of effort at the buying end and at the financing of the buying end in order to protect a construction industry that simply is not coping and can't build at the rate that we need it to, because it is insisting that it does it the way that it's always done it.
You spoke of the European approach using much more, for example, prefab construction methods. I think I heard you say less than 5% of prefab in Australia, and was it 80% now in parts of Europe? What will that do to affordability?
Well, I think we've heard from all of our banking friends today that, look, time is money, and at the moment the time it takes to build a property is between 12 to 18 months, or a home is between 12 to 18 months using traditional methods. Pulling back the cost, basically pulling back the time that it takes, pull it back to the estimates I've seen are around 12 weeks. You can produce a prefabricated home, and we're not talking glorified caravans. We're talking, real homes. Applying manufacturing and logistical thinking to the housing market would allow us to produce homes faster. And if we can produce homes faster, then the cost necessarily starts to come down. But what we see, the National Housing and Supply Council have done some incredible work in that space, understanding it. But one of the things we see is that if you have a building loan to build a home, that doesn't align with a prefab, because they will release money based on inspections which don't actually apply in a prefab space. So there's a lot of adjustments that need to be done.
Thank you. Last question. In your submission, you said that mortgage insurance is punitive and reduces risk not for the lender but to protect the lending institution. Many banks and lending institutions would argue the opposite. Indeed, the previous witness to you, we heard from APPA along different lines, that mortgage insurance exists to support first home buyers. But we know this cost alone can be a huge barrier to home ownership. Can you explain a little more about how mortgage insurance protects lending institutions rather than lenders?
Well, I think you and I are fairly aligned, Senator Pocock, on our thoughts around that lending insurance. We pile a whole bunch of hurdles upon first home buyers. They need to save 20% deposit at a time when they are paying record rents. They need to save a 20% deposit on top of a HEX loan that their parents never had to pay. They are being asked to, save for, and if they take a lower deposit than 20%, then they have to insure themselves against their own risk, so that the banks who, as you mentioned, are reporting record profits don't have to carry that risk. One of the common themes across everything that we're seeing at the moment is that we are de-risking by pushing risk back onto individuals. We are pushing systemised risk onto individuals. And that's happening in the construction industry because of subbies. Basically everything just gets pushed down to the owner and the subcontractors. It happens at the same time around in the financial markets where the individuals are taking on the risk in first home loans. If it's such a risk, why do we want to lend to first home loaners at all? And why does a first home loan holder have to guarantee themselves to the level of a risk of a different kind of home owner? I don't know if that makes sense, but why should I have to prove myself as a first-time home loaner that I am as the same level of risk as an owner occupier upgrading? I think we're pushing it back onto people, individuals, and we've seen the huge cost of that We're seeing the huge cost of that. It is getting harder and harder. And some personal experience, my son's 31, he's trying to buy a property at a level that was at a price that was the same level that my husband and I bought our second home with, and he's doing that on his own. And you see the hurdles that everyone has to go through and think he's a better financial risk than we were in our 20s.
Thank you, and thanks everyone for being there. Thanks.
Great. Thanks very much, Senator Pocock. Well, thank you very much for your time and evidence today. And we now move to our penultimate witness, which is the Helia and the Insurance Council of Australia. I understand that information, let's see if we have these people.
Thank you.
I think we have, yes, we do. We have Helia and we have the Insurance Council as well, do we?
Hi, Chair. Insurance Council here too.
Okay, thank you. I now welcome representatives from Helia and the Insurance Council of Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and capacity in which you appear?
Thank you, Chair. Alexandra Horden, General Manager of Regulatory and Consumer Policy at the Insurance Council of Australia.
And Pauline Blight-Johnston, Chief Executive Officer and Managing Director of Helia.
Okay, thank you very much. Do you each have an opening statement?
Just a very brief one, if I may. Thank you, Chair. So thank you very much for the opportunity to appear before the committee today. Improving Australians, and particularly young Australians, access to home ownership is an important topic. We're aware that the committee has received a lot of interest and submissions touching on lenders' mortgage insurance, or LMI. LMI allows banks to transfer risk outside of the banking system in the case of loan defaults. As such, LMI facilitates priority access to housing for borrowers requiring high LVR loans while protecting financial system stability. These benefits carry no cost to the taxpayer. LMI also plays a role in facilitating lending competition. In particular, LMI allows smaller lenders, such as customer-owned and regional banks, to more fully compete in the high LVR market segment. I know the committee has received evidence that banks have the scale to simply absorb the risk for first home lending by carrying extra capital. This assertion does warrant careful consideration of the varying levels of scale within the Australian banking system. While the largest banks may have the scale to hold this capital, this is less likely to be true for our smaller lenders. An important part of LMI that is regularly overlooked is that it is, at its heart, an economic catastrophe line of insurance. LMI is designed to protect the banking system through major economic downturns. Through periods of sustained economic and house price growth, as has been the general trend in Australia over recent decades, it is easy to lose sight of this key function of LMI. Our submission noted the impact of government-backed demand-side housing programs, such as the Home Guarantee Scheme, or HGS, on the LMI market. Importantly, LMI is open to a much wider range of borrowers greater than the HGS. This includes first home buyers beyond the eligibility parameters of the HGS, or non-first home buyers who may be entering the housing market without significant capital behind them. Government schemes have an important role to play in helping consumers least likely to get there on their own into home ownership. LMI and government schemes can coexist alongside one another, serving discrete cohorts of first home buyers and ensuring there is minimal private market distortion to the benefit of all consumers. Thank you.
Thank you very much. Helia?
Thank you, Chairman. Thank you for the opportunity to appear before the committee today. Helia is Australia's largest provider of lenders' mortgage insurance, or LMI. Our purpose is to accelerate financial wellbeing through home ownership. By insuring lenders against the risk of loss due to mortgage default, LMI gives lenders the confidence and risk management tools to enable them to issue high loan-to-value ratios loans to borrowers with deposits of between 5% and 20%. This is particularly important for medium and smaller-sized lenders to enable them to compete alongside the larger lenders. The volume of LMI business in Australia has reduced significantly, primarily as a result of the government's Home Guarantee Scheme. The magnitude of this impact is challenging for the ongoing viability of the industry, which has a largely fixed cost base and only a small number of existing providers. Refining the home guarantee scheme settings could enable the home guarantee scheme and the LMI industry to work better in harmony to support home ownership across Australian society, with government assistance targeted to those individuals who need it and the LMI industry servicing those with the means to support themselves. Thank you, and I welcome your questions.
Thanks very much, Ms. Blight-Johnson. Can I ask you whether you have any particular views about the way that APPA runs the serviceability buffer?
As we're not a lender, of course, so we wouldn't profess to be the expert in this, but we do certainly agree with the philosophy that it should be countercyclical, which is the stated intent. And I think a countercyclical tool is a very powerful one. We would say that in the current environment, we are not concerned with the risks of lenders that we are bringing onto our books at this point in time. And so I guess it's up to APPA when they decide that the right time is to adjust that in line with the interest rate cycle.
Yeah, I mean, it's a question of degree, isn't it? Because they gave evidence today, and they argue that it's a dynamic buffer, but there are many different ways that you could interpret that, I imagine. So is there a particular way you think they should be talking to the market about this? Because there's a large volume of information that's come to the committee where it would appear that a lot of people don't regard it as a dynamic buffer, even if APPA does.
Well, I mean, dynamic, I guess, means moving, and it has moved. It moved upwards at a point of low interest rates, which made a lot of sense. And I guess at the time that APPA deems it to be appropriate, they may consider moving it downwards when the interest rate cycle is looking in a different place.
Okay. So another proposal that's been put to this committee is to do with the risk weights that are held against mortgages. So, I mean, what is your take on this concept? Do you have a view about that?
I guess as an insurer, I'm very, very big on ensuring that you charge appropriately. You know what risk you're taking on, you charge appropriately for it, and you hold the appropriate capital for it. So I think you need to be very careful if you're looking at risk weights that you come from a fundamental perspective of ensuring that you are coming from where the true risk lies. That's the way that I would encourage anyone to think about it.
Yeah, and in your experience as an insurer, I mean, is there a far greater risk that first home buyers bring compared to the rest of the book?
First home buyers do pose a slightly greater risk in our experience. We wouldn't characterise it as a far greater risk, we'd characterise it as a slightly greater risk.
Slightly greater risk. And what about the capitalisation of the Australian banking system? I mean, the view put by David Murray, I think, was that it should be looking to hold about 25% risk-weighted capital up from 15%. I mean, what do you make of the market as it stands? Do you think that is it a good and globally competitive approach for us to have, or are we holding too much capital, do you think?
I wouldn't profess to be the expert in that regard. I'm sure David Murray knows a lot more about that than I do as an insurer rather than a banker.
Yeah, okay. And what about the LMI market in other jurisdictions? Are there things that we could learn from other jurisdictions that would improve accessibility and affordability here in Australia?
Yeah, the LMI market is very different around the world. Many countries don't have one. Those countries that don't have a functioning LMI market typically charge higher interest rates to low deposit borrowers, or it's more difficult for low deposit borrowers to access the lending system. The system that we think is the most interesting one around the world is Canada. I'm sure you've been referred to that already. It's, I think, deemed in many regards to do a very good job. In Canada, the public and private sectors work in concert to support the lending industry.
Okay.
I'll provide more details of that.
Well, I just want to go to your submission to ask you a couple of points of detail. So in terms of the risk weighting that APPA requires, is it a different risk weighting when someone is using the home guarantee scheme compared to using private lenders' mortgage insurance?
Yes, it is. The lender gets significantly more capital credit for a borrower that is supported by the Home Guarantee Scheme compared to a borrower that's supported by LMI. Now, we also need to understand that at one level, I understand that because the government's balance sheet, I will accept, is definitely stronger than a private insurer's balance sheet. But there's a difference in the level of cover that's provided. The LMI industry covers the entire balance of the loan and covers that loan irrespective of whether it's owner-occupied or investor or changes status on the way through. A first-term guarantee, government guarantee, only covers the loan from an LVR between 95 to 80%. If the value of the property drops below that, the bank is unprotected at that point, and the guarantee falls away if the original purchaser moves out of the home and rents the home out. So despite the greater level of coverage on the LMI, from the LMI policy, the bank gets significantly less capital credited for using it.
Okay, so just so we've had a lengthy debate today about risk capital weighting. So there's a lower level of capital held against a home guarantee scheme mortgage.
Yes, that's true.
And what is it compared to a private LMI? And so what is the difference?
The difference is in our submission. I think it's quite material. It's about a 35% difference, I think.
Okay, so it's quite significant. And I guess my next question is then, so I understand that you've just explained to us that there's it's providing coverage, a different sort of coverage.
Yes.
But what about the risk it represents? Does it represent a similar or comparable risk?
On the whole, we believe the loans that are in the first-term guarantee scheme are very, very similar in character to the loans that the LMI industry insures, and all the demographic data would indicate that they're very similar. It's not really targeting a very different demographic.
So for a similar underlying asset, there's a different risk weighting.
Yes.
Okay. So when APPA was at the hearings earlier, they made the point that they will provide on notice all the various permutations of their model. So with a lot of that, I mean, this is not something that the Parliament looks at on a regular basis. So it sounds to me that there are a lot of judgments made by APPA here when they allocate these risk weightings, aren't there?
Yes, ultimately, I guess that's their job to make those judgment calls.
Yeah. Okay, that's very helpful. Can I come to you, Ms. Horton? So in terms of the Insurance Council position, do you have a view about these risk weighting issues we've been canvassing today?
Look, I think they've been canvassed pretty comprehensively, and I don't have anything to add to Ms. Blight-Johnson's evidence in relation to that.
Okay, but does the Insurance Council sympathetic to the arbitrage that Ms. Blight-Johnson is talking about?
Yes, so as the general insurance industry's representative, we absolutely agree with our members' position on this.
Yeah, okay. So effectively the view is that there has been a distortion in the capital weighting system by the prudential regulator, perhaps for a judgment reason that's maybe defensible, may not be, and your basic argument is that it's regulatory arbitrage.
Our argument would be that a more equitable look at this would be warranted.
Yeah, and are there any other things that you think that we should be considering in relation to this home guarantee scheme?
So broadly in relation to the home guarantee scheme, we do think that there is value in looking at the way that the scheme is targeted to ensure that it is supporting those most at need of support into the housing market. So in terms of the data that we have to hand, we believe that the people accessing the home guarantee scheme are very similar in terms of their LVI, their average LVR, as those using LMI. To our knowledge, the average LVR for first home buyers using the home guarantee scheme between 2020 and 2023 was 93%, and for those using LMI, that number was between 89 and 90%. So it strikes us that cohort that are accessing the home guarantee scheme are very, very close to the LMI pool, and that they should be targeting through there, whereas the group who are sitting above the 95 LVR, who perhaps are able to pay a mortgage as evidenced by their ongoing rental payments but may not have capacity to save a sufficient deposit, that would be where the very necessary government support is probably more appropriately targeted.
Okay. I might just, before I give the call to Senator Pocock, could I get you or Helia to take on notice the detailed point around the arbitrage that you're suggesting exists between the capital weightings, and perhaps give us some examples of how that plays out at an individual level, just so we can understand in a bit more detail the distortion that you're suggesting is applying there?
Yes, we can certainly take that on notice.
Yeah, thank you. Senator Pocock?
Thank you, Chair, and thanks for being here. Do you have any evidence you want to give us about your perspective about what difference access to the home guarantee scheme support makes to a first home buyer?
Was that for, sorry, Senator, for myself or for Ms Blight-Johnson?
Either of you.
Okay. Ms Blight-Johnson, would you like to go first?
I guess the best evidence that we're aware of is the report done, work done by Treasury when this scheme was being looked at, expanded from the 10,000 places to the 50,000 places. And Treasury's analysis at the time indicated that they estimated that about, I think it was around about 90% of individuals using the first home guarantee scheme would have likely been able to buy their home using LMI in a very similar time period. So we believe there's very strong overlap from what we've seen. Now, that may be different for the single parent scheme that goes up to 98%. We accept that would be different. But the base scheme, we think there's a very strong overlap.
So that evidence, and do you have any argument with it, I guess, is that it's helping people, but it's not making the difference but in terms of what their entry into home ownership. Is that, you're nodding, is that appropriate? Is that true?
I think that's a very good way to characterise it. It doesn't seem to be the determinant as to whether or not they would own a home.
No, so it's giving relief, which of course is a very acceptable goal of a program, a very stressful moment, of course, for anyone going to their first home purchase. But what about you're also arguing, I think, that the wrong people, or perhaps those most in need, are not receiving it. Is that also part of your argument?
Ultimately, anybody that qualifies for the home guarantee scheme still needs to meet the bank's servicing requirements. And if they can meet servicing requirements but don't have a deposit, largely the LMI industry can solve that problem for them. And the vast majority of them, whilst I'm sure it's nice for anybody to get something cheaper, that they could actually afford it. So we would really like to work with the government to say, how do we look at, as Ms Horton was saying, perhaps changing the criteria so that the government support is going to those people who genuinely couldn't afford to help themselves using private enterprise solutions.
Right. You've talked about the LMI covering the entire balance of the loan and giving greater coverage than the government guarantee, so different levels of coverage. And you also said that the LMI, the rate of uptake of LMI has fallen since the HGS was introduced. Could you give us the data on that, on notice if necessary?
I can give you the actual numbers on notice, but the industry as a total now is approximately 40% smaller than it was before the scheme was introduced in 2019.
2019.
That's approximately 60% of the size.
If mortgage insurance were not necessary at all because the banks put their hand up to take it on, what do you think would be the implication for home ownership rates and access to housing?
Ultimately, the fundamental premise of all financial services are that the provider needs to charge an appropriate price for the risk they're taking on to be able to manage the service they're providing responsibly through the cycle. So my expectation would be that if the bank was not able to access lender's mortgage insurance, it would need to charge the borrower in other ways for the specific risk that they're bringing to the lender.
Thank you. Thanks for your answers, and thanks, Chair. That's me done.
Thanks very much, Senator Pocock, and we thank our witnesses for their time and evidence today. We now go to our last witnesses of the day, and I now welcome Assistant Professor Ben Spies-Butcher, Mr. Saul Eslake, Professor John Quiggin. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. The Hansard record, please each state your name and capacity in which you appear. You're on mute.
Who wants to go first?
I'm John Quiggin, Professor of Economics at the University of Queensland, appearing in a private capacity.
I'm Saul Eslake, independent economist, appearing here in a private capacity.
And I'm Ben Spies-Butcher, Associate Professor at Macquarie University and also appearing in a private capacity.
Okay. I'm not sure whether you've coordinated this, whether you have an opening statement or how you'd like to do this. Straight to questions?
Can do.
Is anyone, I'm happy to take a brief opening statement if you wanted to offer one.
I'd only, Senator, offer the observation that I think I've made before this committee on a couple of other occasions, that we have decades of evidence that I believe shows overwhelmingly that in a supply-constrained housing market, which we have now and have had for most of the past 6 decades, anything that allows Australians to spend more on housing than they would otherwise be able to do results in more expensive housing rather than in a higher proportion of the population owning that housing. And that while inevitably individuals are able to benefit from various government programs and other developments that allow them individually to spend more on housing than they otherwise would, indirectly their benefits are at the expense of other Australians who, for whatever reason, aren't able to take advantage of those programs or those developments. And I would say that although I recognise some arguments for example, loosening the buffers that APPA requires to test the capacity of prospective borrowers to service loans at higher interest rates, they would in general come into that category of things that allow Australians to spend more buying housing than they'd be able to otherwise. And the likely result of it would be more expensive housing rather than higher home ownership rates.
Yeah. Okay. Well, thanks very much. We'll ask you a few questions and then I'll go first, then Senator Pocock will go, and hopefully we'll be able to get lots of information from you today. So, look, I will start with you, Mr. Eslake. So, now you generally just don't support demand-side measures, is that right?
Yes, that's correct, Senator. What I have argued for a long time is that it would be helpful to the goal of increasing home ownership rates, which I sense is a broadly shared goal across the political spectrum, if governments avoided unnecessarily inflating the demand for housing by enabling people to spend more than they would without government programs. I don't want to convey the impression that simply stopping doing that would solve all of Australia's housing problems. I've always argued that there needs to be action on the supply side of housing markets as well as on the demand side. But as I say, I think there is 60 years of evidence going back to the first homeowners grant scheme that commenced in 1964 that says that anything that allows Australians to spend more buying housing than they'd otherwise be able to results in more expensive housing and lower home ownership rates. And I don't think it's a coincidence that Australia's home ownership rate peaked at the first census after that first, as it was then called, Home Savings Grant Scheme was introduced in 1964 and has been going down ever since, despite the expenditure of, by one count, more than $30 billion in 2021 prices on first home owner grants and stamp duty concessions over the subsequent 5.5 decades.
Yeah. Okay. Well, I understand you've done a lot of work on this, and but you are working for the super funds. Is that right?
No. I undertook a project for the Super Members Council,
was that
which they paid for.
Paid project?
Yes, that was a paid project.
Yeah.
But let me say, I wouldn't have undertaken that work if I hadn't been of the views that I expressed in the paper that I wrote.
I assume that's why they wanted to pay you to do it.
Well, that may well be so. But what I'd also note is that, for example, I have publicly opposed the increase in compulsory SGC rates, which the superannuation industry and in particular the Super Members Council have advocated for.
Yeah.
So in no sense would it be fair to describe me as a spokesperson, paid or otherwise, for the superannuation industry or any of its constituents.
Yeah, well, fair enough. But they do have deep pockets, so I hope they looked after you in that regard. I would say that home ownership, though, is an important part of retirement, though, isn't it?
Yes, it is. Our retirement system has long had as one of its unstated assumptions that the vast majority of people would have close to zero housing costs in retirement because either they would own their own homes outright and thus would only have to carry municipal rates and repairs and maintenance costs as part of their housing costs, or for the relatively small proportion historically of Australians who haven't been able to achieve home ownership by the time they reach retirement, they'd be housed in social housing where rents were fixed as a relatively low proportion of their relatively low incomes. That assumption is still largely true at the moment, but given the very rapid declines in home ownership rates among people who are 55 or under, and even more so, the decline in the proportion of people who reach their 50s and ultimately the normal retirement age without having paid off their mortgage, that assumption is going to become increasingly invalid.
Well, I mean,
so we do have a problem on that front.
As you know, I mean, the ABS say that 32% of the lump sums that came out of super last year were used to pay off mortgages. So,
indeed.
So that's a problem.
And that's rational from the standpoint of people who find themselves in that position, reaching retirement while still having outstanding mortgage debt. It's entirely rational for them to pay off their mortgage, but it runs contrary to the intention of the superannuation system.
Well, these things can be changed by Parliament, as you know. But as you know, the Super Members Council is doing its best to ensure that a future Parliament does not make those changes, which is why they commission you to do this piece of work, I imagine, because they know about your views and they know that you are happy to help them. Did you conduct any new modelling for the Super Members Council report?
No, I didn't.
So what about the assumptions in the report? Where did they come from?
Well, they made assumptions about increases in house prices, which I referred to but did not use in my analysis. All I said was that the weight of historical evidence was that, as with anything else that allows people to spend more on housing than they'd otherwise be able to, allowing people to withdraw funds from their accumulated superannuation accounts would result in more expensive housing. And I quoted a range of estimates, including not just those of the Super Members Council modelers themselves, but also of the Grattan Institute and a couple of other people.
Okay.
But how much house prices would rise was not particularly germane to the findings I reached. I did rely on modelling by Super Members Council on things like the median superannuation balance, the proportion of people in different age groups who would be able to withdraw the maximum amount under the scheme that your colleagues are proposing, and things like that. But it wasn't crucial to the analysis or the report which I wrote, how much house prices were likely to rise.
Okay, so SMC provided some of the inputs.
Yes, and they were disclosed in, as they should be in such things, in the footnotes to the various tables.
Okay, and are you able to provide those assumptions?
Yes, I can. If you like, I can send to the Secretary a copy of the report which I wrote, and all the assumptions in it were disclosed. The report's also on my website if anyone wants to access it that way. It's in no way a secret document, but I can certainly send it to the Secretariat of this committee if that's your wish.
Yes, please. And did Deloitte provide any input as well?
Not to me directly, but I referred to a report which they have published, a public report, estimating the cost to the budget over an extended period as a result of encouraging a shift in savings from a form which is taxed, albeit concessionally, namely superannuation, to a form which is not taxed at all, namely owner-occupied housing. So they undertook some estimates of that, which I quoted and noted where they were sourced from.
Yeah. Did you go through a process to check whether your work was actually closely reflecting the coalition's policy, or were you undertaking a different task?
I'm not quite sure what you mean by that question, Senator, but I quoted the coalition's policy at some length in the introduction to that part of the report. I think I quoted some statements of yours in a couple of instances, and I quoted from a number of supporters of the scheme to outline what I understood it to be and what I understood that its supporters believed its benefits would be, in order to be as fair as I possibly could.
Yeah, so just so I understand, so your view is that the super for housing idea is bad, but that there shouldn't be a higher super guarantee rate?
Yes.
Okay, because you think there's too much.
And I mentioned that explicitly, Senator, just in case anyone is inclined to think that I am a spokesperson for the superannuation industry and that I would say anything that they wanted me to say. There are instances where I agree with them. There are instances where I don't. I think it's fair to say, as you did, that they wouldn't have asked me to undertake this particular piece of work if they thought it was likely that I would say that the scheme was a good idea. I think that's kind of pretty obvious. But nonetheless, they made no attempt to dictate what I would or wouldn't say in that report. And people who know me well know that no one ever tells me what I can or can't say. I've resigned from organisations where management has tried to do that.
Yeah, I understand that, but the reason I'm asking you these perhaps annoying questions is because they're trying to influence a significant public debate. So I guess I'm just wondering whether there's anything else you could tell us about this report, how much it cost, whether you provided them with a draft before it was published, those sort of things.
Well, yeah, I don't regard your questions as annoying at all, Senator. They're perfectly fine. I suspect it's a matter for them to disclose how much they paid. If they want to, they can. I'm not sure that it's appropriate for me to disclose how much I charge my clients for undertaking various pieces of work. But if they choose to, that's a matter for them. Yes, I provided them with a draft report before it was finalised. That was partly to let them know how things were going. They made some suggestions as to things that they would or would not like to have seen in it. I accepted some of those suggestions and rejected others, but in every case, the decision as to what was in the report and what wasn't was mine and mine alone.
Okay, well, if you could just take on notice the question about how much you're paid for the report, we would be grateful. And finally, because I want to give the call now to Senator Pocock, I'm fascinated by your evidence that you think the super guarantee is too high. Is that because you think...
No, sorry, no, Senator, let me be clear about that. What I was opposed to was increasing it from the level at which it had been around 2015, 2014. As I recall, the Rudd-Gillard government had proposed increases in it, and the Abbott government put those off for a couple of years. And then I think, correct me if I'm wrong, somewhere around 2016, 2017, legislation was passed authorising increases in it from about 2022, if I recall correctly. It was those increases in the SGC rate which I was opposed to.
Why do you oppose those?
On the grounds that for most people, 10% or whatever the contribution rate was at the time was sufficient to provide an adequate income in retirement. Now, that doesn't apply to everyone, in particular women who are more likely to have interrupted careers, may not require, for the period that they do, that they are in paid employment, the then maximum rate or the then required rate under SGC might not have given them an adequate income in retirement, but there are other ways of dealing with those issues, including, as I think is now legislated, the government making payments to women in particular who have periods out of the workforce where they're caring for children or other relatives. And I think that's a more effective way of dealing with that problem than increasing the overall SGC rate.
Okay, sounds like a good argument for super for housing, but with that I'll go to Senator Pocock.
Thank you. I've got questions for all three of you, but I just wanted to say to you, Mr. Eslake, is there anything further you want to say in defence of your independence? You've made a vigorous defence of it, but I just want to give you the chance to say to anyone listening, I understand you've had a long career, as any of us know, as an economic analyst, and I understand you've also probably done work for a broad range of organisations, civil society, governments, economic organisations, financial services. Is that correct?
Yes, it is. I have done work for both sides of the political spectrum at different times in my life. I don't normally make a point of this, although Senator Bragg may be aware that my interest in housing policy first began in the late 70s and early 80s when I was a member of the Young Liberal movement. And one of the things that I was told when I first joined the Young Liberals was that the introduction of the first homeowners grant, or home savings grant scheme as it was then called, was an example of how the Young Liberals had been able to influence policy, because the idea came out of the New South Wales Young Liberals in 1963 when its president was one John Howard. However, at that time, I was also beginning my career as an economist working in the Federal Treasury. So by the time I became Federal Vice President of the Young Liberals in 1980 and then Federal President of the Young Liberals in 1981, the first Tasmanian to hold that role, I had become convinced that first homeowner grants were a bad idea, because what they did was inflate the price of housing rather than increase the number of people who were able to become homeowners. And ever since then, I've called first homeowner grants second home vendor grants, because that's where the money ends up. And, I've had the view that I expressed here for 45 years since then. But more generally, Senator, I'll reiterate, since you have given me the opportunity to, that nobody tells me what I can or can't say. And on 2 occasions during my career, I have resigned from organisations that have tried to tell me what I can or can't say. People are willing to, if they want to hire me to write things because they know what I'm likely to say and they think that me saying it will help their position, well, that's fine. But nobody is ever going to be able to get me, no matter how much they want to pay, to say something I don't believe or not say something that I do believe.
I think your reputation is intact. So if I can go to my questions, and I say that as someone who once gave evidence on your side of the table in front of Senator Erica Betts, as he was at that time, and he called me Quisling, or he implied that I was in the pay of the ACTU because I'd once taken a grant from them. And I know how irritating I found that. However, let's move along. You make an argument that that stimulus on the demand side just kicks up the price and locks out people from being able to purchase and doesn't address the true problem. But not all supply and not all demand is the same, is it? And I just want to give you the stats for the last 10 years. On population change, 15%, increase in the number of dwellings, 19%, but increase in price for housing of 75%. So what we have, you're nodding. What's going on there? We have had a lot of supply come in the last 10 years. We've seen it push up the price because of the composition of the purchaser, I think. So can you comment?
I think there's a couple of things at work there. One, that growth in the population itself is an incomplete measure of the growth in the underlying demand for housing, because various social changes have had the effect of reducing the number of people per dwelling, such as smaller families, the ageing of the population and family breakdown, all result in, on average, fewer people per dwelling, and thus a greater underlying requirement for housing for any given increase in the population. Second, there appears to have been, as far as you can tell from census data, an increase in the ownership of second homes, holiday homes and things like that are vacant for much of the year and only used by their owner rather than being let out. Relatedly, there's been an increase in the proportion of the housing stock that is not occupied by its owners but is used for short-stay tourist accommodation, including presumably for overseas tourists as well as interstate Australian tourists. That would have impacted the relationship between population growth and housing demand. The final thing, of course, is that when economists talk about housing demand, they're not only talking about the number of people demanding houses to live in or even to own for an investment purpose, but also how much they're able to and willing to pay for it. So, in other words, what's driven prices is not simply the difference between the number of households requiring accommodation and the stock of housing, but also the financial resources that those who buy housing are able to bring to the task, to the business of acquiring housing. And in addition to government schemes that put cash in people's hands, such as first-time owner grants and stamp duty concessions or tax concessions for property investors or mortgage guarantee schemes or shared equity schemes, but in addition, things that are not the result of government policy, but lower interest rates and easier credit conditions have made it possible for people who would have been able to buy a home anyway, to buy a more expensive one or to pay more for a house than they otherwise would. And in a supply-constrained market where people have the capacity to spend more on housing as a result of something, be it a government policy or a development in financial markets, then the result is more expensive housing. And that's what the history of the last 6 decades, and in particular, the history of the last 3 decades since interest rates came down from their late 80s, early 90s peak, tells us.
In your submission to previous inquiries, you've made a number, you've said investor demand has been a major cause driving up house prices. How has the interaction of negative gearing and capital gains tax discount contributed to the last decade or thereabouts of house price growth, declines in the home ownership rate and wealth inequality?
Well, I would say that you have to go to 1999 when the capital gains tax regime was changed from what it had been since 1985, imposing capital gains tax at a taxpayer's full marginal rate, less an allowance for the impact of CPI inflation on the value of the asset, to a regime which taxed the nominal gain at half the taxpayer's otherwise applicable marginal rate. What that did was to convert negative gearing from a strategy that had always been about deferring tax to one which was about both deferring and reducing the amount of tax, by in effect converting wage and salary income into capital gains. Wage and salary income, of course, is taxable in the financial year in which you earn it. Capital gains are taxable in the year in which you choose to realise the gain by selling the asset, and since 1999 taxed at half the otherwise applicable marginal rate. So although the number or the proportion of taxpayers who were negatively geared property investors had been rising during the 1990s, in part, I suspect, because the terms on which banks would lend for investment properties eased in the early 90s. The premium on interest rates for investor loans disappeared in the 1990s. But there was a dramatic increase in the proportion of the population who had property investments, and in the proportion of those who had property investments who were negatively geared, reaching a peak, I think, of about 70% just before the onset of the global financial crisis. Now, over the following 13 years, as interest rates came down, and particularly during the COVID period, the proportion of property investors who were negatively geared fell substantially, simply because it became very difficult to be negatively geared when interest rates were as low as they were. I suspect that when we get figures for 2023-24, which won't be until 2026, the proportion of property investors who are negatively geared will have gone back to somewhere close to where it was at its peak in 2007-08. I also argue to the second part of your question that although defenders of negative gearing and the capital gains tax discount maintain that it is essential to ensuring an adequate supply of rental housing, over 70% of the amount of money that's lent to property investors for the purchase of housing is for the purchase of established housing, which means that those investors who purchase established housing are not adding to the supply of housing. They may be adding to the supply of rental housing, but in outbidding a prospective owner-occupier for the established houses which they purchase, they are adding to the demand for rental housing by exactly the same amount. So that if negative gearing and or the capital gains tax discount were to be curtailed in some way, or even dispensed with entirely for established housing, then it may well be true that that reduces the supply of established housing that's available for rent, but it would reduce the demand for it by exactly the same amount, and there would therefore be no impact on rent at all. And if the end result of any reforms in this area were to be that new housing was the only investment vehicle for which negative gearing and or a capital gains discount was available, the result may well be an increase in investment in new residential housing for rent, which would be a good thing, in my view.
Thank you. Thanks for all of that. If I can come to you, Professor Spears-Butcher, what suggestions are top of your list for improving housing affordability and home ownership rates without pushing up house prices?
Thank you, Senator. And I broadly agree, just to say, with that analysis that Mr. Eslake gave. But I think it's also in a context where the liberalisation of financial markets and a broader shift in profit models globally has increasingly emphasised both capital gains and leverage as models for being able to convert annual income into capital gains income effectively. So that's not just happening here, but here that's happening a lot, and it's particularly happening through housing because of the way credit markets work, which is that most people can't borrow 80% of the money to invest in BHP shares, but they can borrow 80% of the money to invest in another home or another investment property. And so that skews, this interaction effect is very important. So I think any changes that disincentivise models which are based on capital gains as the primary or as a primary mechanism for realising income are going to have positive impacts on affordability. And so that goes to the capital gains tax concession, it goes to negative gearing. I think it even goes to the capital gains tax exemption for the family home as well, in an era where being able to own a property is less likely to be as universal as it was in the past. And I think there's an argument about that. But I think it also goes to a couple of the things which are, you might say, creating a floor under the market. One is just how important the mortgage market is to the wealth effect in Australia and to macroeconomic management, as well as to credit ratings generally, and also to employment in the construction industry, which I think it's reasonable to infer that some of the emergency action during the GFC and COVID were a response to the negative implications of a rapid and sudden fall in house prices. And to the extent that that's the case, then I think the government has implicitly assumed some of the downside risk, which is reinforcing this model. But you also notice that at those moments when prices fall and investors are clearly worried about the prospects of capital gains into the future, you see a sharp uptake of first home buyers into the market who aren't concerned primarily about capital gains, they're concerned about tenure. And this lopsidedness is caused by the unevenness of tenure distribution. And so it's because private rental is so bad in terms of its tenure, and that for many people who have the means to be able to invest differently, it means moving schools with their kids, having to move further away from family, even having to change jobs regularly because of the insecurity of tenure in the rental market, that also artificially creates a floor. So I think we want to, if the policy goal is to create secure tenure, then I think directly creating secure tenure by ensuring that all private rentals are more secure, and by expanding the stock of public housing and social housing which guarantees tenure security is a much more direct way of being able to address these issues. And I think doesn't have the entry of public investment doesn't have the same problems that the subsidy of private investment has because of its ability to guarantee tenure, its ability to target new construction, for example, as well, and partly the relatively low cost because the government's already assumed some of the downside risk. And so when it comes in, it's actually effectively coming in to get more upside and less downside. So I think those tenure security measures are really important. The tax changes, the disincentivise capital gains oriented models and investment are really important in order to be able to address the problems. Thank you.
Can I bring you in, Professor Quiggin, on these issues? What is your response to that? What's your view about what's most important to get right now on housing to improve, to deal with inequality and improve housing affordability?
Yeah, in my view, the security of tenure issue is really the biggest single one combined, I guess, with increasing supply. But and so that's I've mentioned that I don't think creative schemes like shared equity are really going to do any good. I think the Housing Australia Future Fund had a whole bunch of features which cosmetically made things look good, but really were not very useful. So in my view, what we need to do is develop a better rental sector than we have, which means return to public housing, which has largely been abandoned, but also addressing the non-welfare part of the market through build to rent. And I think those two things together are essentially what the so-called NIMBY movement is largely about, of providing incentives to providing a structure which creates something more stable than the kind of reliance on individual contracts between tenants and landlords with one or two or three properties. I think that's a recipe for poor tenure and so forth, and and that's been incentivised, of course, by the structure of capital gains discounts and negative gearing that favour that mode of investment, which of course isn't relevant at all either to social housing or to a corporate type build to rent model.
Thank you. Thanks very much for your evidence and for being here today. Thanks, Chair.
Thanks very much. I think that is all we have for you today. I was going to ask Mr. Eslake something else, but he's gone. So that concludes today's hearing. Thank you to all witnesses who appeared and to Hansard Broadcasting for their assistance. If you've taken any questions on notice, please provide your responses by Thursday, 7 November 2024. I thank everyone today, and the committee stands adjourned.